Good morning, good afternoon, and good evening, everyone, and welcome to our Spring 2025 IPO Bootcamp. My name is Colin Mahan, and I'm a Director of Programs at the NASDAQ Entrepreneurial Center. And for those of you who may not know, the NASDAQ Center is a nonprofit improving access and knowledge in entrepreneurship to advance economic progress for all. As we'll see in the chat in just a moment, the NASDAQ Center provides programs, resources, and exceptional mentorship to help entrepreneurs fuel prosperity no matter where their journey begins. Be sure to check out those links and resources shared in the chat. Now, just a couple of housekeeping items before we get started. First, let us know where you're dialing in from by dropping it in the chat. We'd love to see where everyone's joining for our time together. Second, we're going to have live Q&A at the end of each panel today, so please feel free to submit those questions at any time using the Q&A function at the bottom of your screen. We'll do our best to get to as many as we can. Now I'm going to launch a couple of polls to take a step back and take a temperature gauge on how all of you are doing today. We use this information to provide programs that guide us to our additional programs for the entrepreneurs out there. So if there are any specific topics or challenges you'd like us to create resources for, feel free to share them in the chat. The first poll is, how are you feeling about your business? Are you optimistic? Are you surviving? Are you anxious? Let us know. Looks like there's a healthy dose of optimism out there. I'm gonna let this run for another moment or so. Thank you for participating. Share those results. Looks like optimism is in the lead. That's good to hear, and totally understand the survival mode out there. So we'll get to it. The second poll is, what's keeping you up at night? Is it finance, scale, marketing? Let us know. While you're answering, I'd like to take a moment and recognize the incredible support of our corporate partners. The work we do at the center wouldn't be possible without all the generosity and belief of our partners in funding, including NASDAQ, Wells Fargo, KPMG, JP Morgan Chase, Wilson Sonsini, Walmart, the Nareet Foundation, and BPM. We're deeply grateful for their partnership and hope you'll join us in sharing that appreciation. I'm going to end that poll. Share those results. Looks like finance is at the top of the key, which is good news because that's what we're going to be talking a bunch about today. And thank you for voting for those other topics. We'll get right to finding experts in those arenas. So we're going to take a quick look at the agenda for today. We're going to kick off our program with an IPO market update, then jump to our first panel, preparing for and staying on track for your IPO, followed by a quick break. Then we're going to transition into our second panel where our panelists will share insights on executing your IPO, followed by another quick break. To round us out, our last session will cover achieving success as a new public company. Please note the same Zoom link will be used for each session. So with that said, without any further delay, please join me in giving a warm welcome to our first presenter to share the market update. JP Diddy is a managing director at KPMG. JP, so glad to have you. Over to you.
Nice to see you, Colin. Thank you very much. Good to be in touch with everyone. Colin, can you hear me okay?
Sound great.
Okay, perfect. Pleasure to be on again. I think we did this back in February and did an update at that time as well. So a little bit of a market update since that time. I think the main overall theme, which nobody's going to be surprised about, is that volatility continues to increase, uncertainty continues to increase, at least as it is with respect to the market. Right now, since the November 6th election, we are down about 11% on the NASDAQ. We're down about 8.5% on the S&P. As you all know, at one time we were down nearly 20%. So really into those correction/recession territories, which, I think makes all of us individually nervous from a 401k perspective or a investment thesis perspective. But more importantly, I think that negativity or that uncertainty certainly has an effect on the financial markets, both from an M&A perspective and an IPO market perspective. So with that, we'll go to our first slide. And these slides tend to be pretty consistent each time we give an update. There's a new Q1 2025 marker there. Put in green box here, the really driving the market and a lot of this uncertainty is the recent tariffs, which we're all very familiar with. I don't think we're all necessarily familiar with how they're going to work and who's going to have agreements and who's not going to have agreements and who's going to have 150% tariffs and who's going to have 10% tariffs. But those are, again, all uncertainties around what's going on there. These certainly have had a negative effect on the market. They've had a negative effect on business, which again, definitely affects the overall market. From an M&A perspective, the top row there, there's been about 4,000 so far in Q1, which is just slightly under the pace for last year. I think some of that was probably a little front-end weighted in Q1 in January and February, because I think the uncertainty really started to increase in February and March and now through April. So we're not materially off from a volume perspective. We're still off a little bit from a dollar perspective, but we actually see those things slowing into Q2 and Q3 as the uncertain or the lack of certainty increases. Now, obviously, if some of these tariffs and markets get squared away, that could correct itself quickly. As we've seen, the ups and downs over the last several months have been pretty dramatic. Even I'm just looking at my screen today, the markets started off down 700 this morning, and now they're down 200. So who knows? They could be up by the end of the day, or they could be way down again. From an IPO perspective, I think that's going to have actually a more dramatic effect given the uncertainty in the market. There's already certainly been a lot of IPOs that have been pulled. I happen to focus in the technology sector, so that's kind of generally where I see most of the or where most of my focus is. But I remember an April 7th title that said or headline that said the IPO boom is canceled. So big names like Klarna and StubHub have taken back their IPOs along with many others. Down here it shows that there's been about 99 IPOs so far this year. It's actually pretty misleading because more than a third of those have been in the SPAC region or in the SPAC area. It's interesting. I saw another headline that said SPACs are the insects of the financial world because they continue to thrive even when markets are tumultuous and very down. And of those 99, 16 new filings for SPACs, 11 SPACs that actually priced, and 9 SPACs that actually found targets in Q1. So that's 36 of that 99. So pretty dramatic amount. But I think it's fair to say that from a U.S. markets overview perspective, the M&A market and the IPO market are going to be down for this year relative to last, and last year was down relative to the prior several years. So a lot of uncertainty, and we'll obviously play this out over the next 3 quarters. Next slide. U.S. M&A market by sector. This isn't really focused on volume or dollar amounts. It's really just distribution by sector. I think this is kind of a helpful slide, not super helpful. I think the biggest takeaway here is that pretty much over the last 10 plus years, the sectors are very consistent. They do fluctuate a little bit here and there from what's in favor at the time or what's being driven by M&A in different sectors. But for the most part, it's pretty consistent. And you can see that in industrials, consumers, energy, fintech, healthcare, IT, which includes TMT. So next slide. Multiples by sector. This is always pretty interesting from my perspective. It takes into account a lot of different data. I think one of the things we'll see if we do get into a recession or if we do get into a pretty dramatic slowdown, there's generally a flight to quality. And from an M&A perspective, flight to quality generally means profitable companies. companies that are losing lots of money. People are not going to want to necessarily get behind just because it's too expensive from a go forward basis. So I think EBITDA multiples will become increasingly important. And candidly, um, for most sectors, EBITDA multiples are very important. It's really in software where I spend most of my time that we really focus on ARR and revenue multiples. So you can see that over the last couple of years, depending on the industry, those have fluctuated within a pretty small band. Q1 2025 for technology revenue multiples is showing up pretty materially. I think that's driven by the fact that we have fewer M&A and again, a flight to quality. So people are willing to pay extra for good companies. One thing that, as the leader of software M&A within KPMG, one of the things we're seeing, especially from the private equity community, is that they do not want to see mediocre deals. And as a banker, we do not want to bring mediocre deals because they are not going to get done. If you're a kind of B-ish company, you should probably just weather the storm. But if you're a B plus, A minus, A company, there is definitely going to be a market for you because there are fewer groups out in the market being sold or being bought, depending on which nomenclature you like to refer to. But high quality companies will continue to get outsized premiums in the market from a trade perspective, just given the fact that people are really looking for quality companies. Next slide. From an M&A financing and PE capital analysis perspective, the top chart is on global fundraising. And as you can see, the fundraising has continued to come down over the last several years. I think this is hand in glove with the chart right below it, which is the dry powder. Obviously, as the dry powder continues to increase, there's less of a need to go raise new funds. The one thing I will mention there is that a lot of the capital going into new funds is for like brand new funds, right? A lot of the bigger firms, people are splitting off and going to do their own things as funds get bigger and bigger. For some of the historical investors, people like to get back to their knitting and they'll go raise a little bit smaller funds. But it's also a canary in the coal mine from the perspective that the dry powder continues to increase because people are unable to put the money to work. There just aren't enough quality deals out there, and people are not willing to do mediocre deals. With respect to the chart below, obviously we are all very aware that we are past the days of zero interest rates back in 20 through 2022. When those started to rise, kind of mid-year 2022, there was a pullback effect for the private equity firms because, or even strategics as well from a buying perspective, because now the cost of capital was, increasing and much higher than the 0% they were used to, or even not zero, but very low. But now I believe the buyers are, getting used to a normalized level of interest rates, which is fine. That's how businesses work. We all know that zero interest rates are not sustainable for the long term. So I think people are at least comfortable with the interest rates that are out there in available funds. Next chart, the M&A outlook for 2025, and I specifically said TBD and parens just because of the volatility we're seeing. And obviously there's, as we just went through some of the slides, there's a lot of dry powder out there. So whether it's strategic or private equity firms, there is capital willing to be put to use. If markets continue to decline, that will slow the effect of M&A because people tend not to want to make investments given the fact that if they think it's going to be cheaper tomorrow, then they might as well wait. If markets stabilize, then people will at least know where they are. And if they start to increase, people start to buy more, mostly because they'll think that the targets they're looking after will be more expensive tomorrow. So Relative through Q1 2025, we're roughly on pace for 2024 numbers, which it's been pretty consistent over the last few years from an M&A perspective. One of the things we probably should have covered on an earlier slide, I know this is an IPO, preparedness meeting, but one thing I think is important to keep in mind is that for every IPO, there's at least 100 M&A transactions that take place. Obviously, it varies a little bit by sector and size and things along those lines, but and a lot of the M&A is done at a much lower level than IPOs. But as we've all seen I've been doing this for 25 years. There's others who have been doing it a lot longer. The size of IPOs continues to get bigger as the companies get bigger, as the IPO targets, continue higher growth rates. Private equity and growth equity firms are holding on to those longer because those are areas of significantly increased valuations that they'd rather have on their books than sharing with the public. But eventually they will have to because that's how they get liquidity. Next chart. So I don't think any of this is a surprise to people, but things to consider as we come out of Q1 into Q2 for 2025, the impact of the reciprocal tariffs, along with direction of inflation and interest rates. I think inflation is potentially up there with tariffs. I think interest rates, as I just talked about, people are pretty comfortable with now from a go forward perspective. I don't think they're going to go up materially. I don't think they're going to come down materially. They may fluctuate, a point up, point down over the next year, 2 years, whatever it may be, but we'll see. But certainly the reciprocal tariffs and inflation could have a major impact. I think we all saw this morning the announcement that there was a little bit of a pullback in Q1 from a buyer's perspective. And I think that's going to have ripple effects over the next several quarters because those things don't tend to change very quickly. Persistent low unemployment rate at 4.2%. That's generally a good thing. I think that is understated for the time being, given the recent federal firings and return to work for some of those individuals, given what's going on in the courts to try and block some of those firings. Certainly, the U.S. government is the largest employer in the country, and the fact that there has been a lot of firings is certainly going to increase that employment rate. I'd also say that from a level of worker perspective, I think within the government, there's probably not a very high level speculation that a lot of those workers probably need those jobs pretty badly. So there's going to be, a lot of people looking for work who need to get right back into the workforce and are not necessarily retiring. The impact of the tight credit markets, certainly interest rates, as we already discussed, are where they are, but we're out to market with the deal right now, and there's fewer turns of debt available for buyers for their target companies. So what used to be in the software sector, which used to be 5-6 times EBITDA or 2 or 3 times ARR for debt for private equity firms, it's much lower than that. Now we're starting to see 1, 2, 3 times, which will have a little bit of a chilling effect on returns over the long run. Hard landing versus soft landing versus growth. That's the $1 million question that everybody wants to know, but we're not going to find out till we're in the middle of it. Right now, it's kind of a soft landing, moving towards a hard landing / recession, but we'll see. Hopefully, we can get out of that mess. And then the current political environment, obviously not only in the U.S., but Canada just had their elections, and France and many other countries, but the whole right versus left and conservative versus liberal, the arguments within the U.S. between the powers of the executive branch, legislative, judicial, those are ongoing, and who's reaching for more power. Global isolation versus and global protectionism. Countries seem to be pulling back and watching the U.S. from the perspective of their country first. And then obviously the wars throughout the globe, which are not good for anybody from my perspective. But hopefully, Russia and Ukraine will get that worked out. Obviously, there's some things going on and always going on in the Middle East, Israel and Hamas and others. And so, um, hopefully the overall saber rattling can come down, but that'll certainly have an effect on the global economy. And that's Colin, the overview for now.
Awesome. Thank you so much, JP, for that market overview. If you could hang with me for just a second, there's a couple of questions here that came up during
Sure.
your talk. So there's a question here. You were talking a little bit about high quality companies. Can you help define what that means?
For sure. And there's always well, I get the question a lot. It's, hey, I'm doing, 20 million in ARR. What's my valuation? That's until you really dig in, that's a impossible answer. But what defines a quality company is a scale, right? Obviously, a company doing 50 million in ARR is higher scale than a company doing 20 million in ARR. What's the overall growth rate of the company, both on the revenue side as well as the EBITDA side? Are you burning a lot of capital? Are you EBITDA positive? What's your gross margin relative to others in your industry? The biggest one is probably what's the TAM, right? You could have two companies doing 50 million in revenue, but if one company's doing 50 million and their TAM's 100 million, they already have 50% of the market, so not that much upside. Or you could have another company doing 50 million in revenue and they have $1 billion TAM, right? And so there's obviously much more upside there. What's the competitive environment look like? It could be a highly competitive industry where you're every time you win a mandate, you're ripping replacing somebody out, or it could be a total greenfield opportunity where the market adoption is ripe for taking on your product. So there are a lot of different things that go into what makes up a quality company, and those are all components of it.
Well, thank you for that, JP, and thank you for the market update. We're all going to have our eyes on what the next 6 to 8 months has up in store for us, but appreciate you joining us for this.
Thank you.
All right, for everyone on the call, up next, our panel of experts are going to cover preparing for and staying on track for your IPO. So please join me in welcoming our moderator for the conversation is Suchi Rana, who's Global Head of White Space Intelligence at ServiceNow. We have Austin March, who is a partner at Wilson Sonsini. We have Shivani Sapori, who's a partner at KPMG, and Dan Angus, who's a managing director at NASDAQ. Team, welcome. And Suchi, over to you.
Thanks, Colin. Hello, and thank you for joining us. As Colin mentioned, I'm your host and moderator for this conversation, and I'm delighted to welcome our esteemed panelists to talk about preparing for and staying on track for IPO. So chime in with any questions that you might have or any comments, and we will do our best to address them. With that, let's get started. Thank you all again for being with us. Can each of you just take a minute, introduce your work, and what role do you play when companies are planning for an IPO? And where are we in general from an IPO readiness perspective, really, when it comes to this market? Shivani, how about we start with you?
Sure, thank you. And thanks to the NASDAQ Entrepreneurial Center for having us here today. My name is Shivani Sapori. I'm an audit partner with KPMG. I do specialize in working with high growth technology companies, specifically in the startup phase through exits. And I'll use that broadly because we do end up working with companies that go through M&A and IPO exits as well. So this is an area that I do spend quite a bit of time with. As far as the types of services we tend to provide for companies and where you would end up seeing us in process, it's going to come in a couple of different forms. So KPMG is an accounting firm. So for me specifically, I do audits. And what that means is as a private company, if you have debt covenants that require audited financials, or if your investors are looking for audited financials, that's usually where we initially come in. And then as you're ramping up to an IPO, you would end up transitioning to a public company type audit, which similarly, we would be able to take you through that process too. So that's one way that KPMG would be supporting an entity in an IPO process. The other way is through consulting type services. So providing IPO readiness services, which would include technical accounting, and then also helping you project manage your way through an IPO process, and also identifying where you might have gaps as you are building your business to be IPO ready and afterwards as well. And then we also do tax services, which would include your basic, federal, state, local taxes, also international tax compliance too. And all those are things that you want to make sure you have in good shape before you actually undertake an IPO process. And then lastly, we also do a lot of other financial transformation type activities, but one of the other key areas for your IPO journey would be SOX readiness. So your internal control structures and helping you build out that framework.
Wonderful. Thank you. Dan, from a NASDAQ perspective, what role do you play? And then where are we from a current market standpoint as far as IPO readiness? What does that even mean?
It's a question that becomes even more existential as time goes on, but I appreciate it. Hello, everyone. My name is Dan Angus. I oversee private company relationships here on the West Coast for any growth stage companies that are looking to enter the capital or the public markets. On the one hand, I help bring information to them about what our exchange requires and the steps involved. And then once they are firmly on the path, then I help them have a flawless launch onto our exchange from a trading and marketing standpoint. Nothing, strangely enough, ever since Liberation Day, there hasn't been much deviation in terms of the timeline for companies that have already committed to going public, with some exceptions, and they have been marginal. So far, companies that, let's say, were targeting May have pushed back to June, and those that were targeting September have pushed back to October. I say that with a bit of hesitation because I think everyone, including those companies, are still trying to digest the long-term implications of what's going to happen, and all decisions are being made really on a real-time basis. I would expect that while we had hoped for a more robust IPO environment at the beginning of the year, and certainly there were companies lining up in queue to do so, there have been a number of sectors that have already, even before Liberation Day, decided to shut down, so to speak. Those happen to be companies in the biotech and pharma sector. Most notably, we do find that tech is somewhat ambivalent at the moment. They are still trying to understand whether or not this timeframe is fruitful. And then from the standpoint of what might actually be active from an IPO standpoint, med tech happens to be the only real cohort that have shown persistent IPO preparedness and intent to get out, and their timelines have generally been strong and steady. How a company prepares in this environment, the standard steps involved, which we will be talking about later, still apply, and nothing really has changed from that kind of linear process. What I think becomes more paramount to these companies is, granted, banks, advisors, all of the typical players in this process, including NASDAQ, they become a little bit more important from a leading indicator data standpoint, at least vis-a-vis those companies. So becoming tighter with those advisors, becomes more paramount. But I would also argue that, for example, we've seen advisory boards become more in vogue for companies outside of, let's say, the medical fields. And there's a reason for that. It's because companies are looking for a stronger data bank of data points to help inform what they're going to do. And so just by habit or practice, one of the things that I'd hope that everyone kind of takes away here is to, really cultivate, new methods of gaining information about the markets relative to your company. And, just the advisory boards is just one indication, but I think that's going to be a lot more important as time goes on.
Great, thank you. Austin, from your perspective, have you seen any shifts in the market when it comes to IPO? And also tell us about a little bit about, your role in.
Yeah. Thank you very much for having me. We're really looking forward to this discussion. So I'm a capital markets and public company partner at Wilson Sonsini, where we represent tech and life sciences companies across the country and world. We're a full service firm, so like KPMG, it's not just the corporate group that helps with the IPO process, but it's important to have specialists like regulatory advisors and compensation and benefits folks and the like who can help guide you through a holistic process, because this is a full team effort to go public. To Dan's point, the process for going public hasn't fundamentally changed in these market conditions. I think the biggest change that we've seen is that the testing the waters process and the engagement with investors early on and continuously has become even more important than it was before, because as companies prepare to go public, these investors expect to have seen a track record of success where you say you're going to hit X threshold, X revenue, whatever, and then quarter over quarter, it's not just that you've hit it once, but you continue to execute on that business plan. And so engaging with investors early so they see that track record of success, they know your company, they're ready to invest. It's not, a 2-week roadshow where you meet with somebody for 30 minutes and that gets you what you need to build a book. It requires consensus building and engaging with investors early so that there's real momentum and buy-in from the key investors who are going to be the long holders of your stock.
Right. Thank you. Dan, maybe I'll come back to you for a minute. What are some misconceptions, or maybe there's one or a few, that startups have when they think about going public or getting themselves ready to go public?
Yeah, one of the biggest misconceptions that come into focus, especially when you're actually, the week of IPO pricing, is that developing a relationship with analysts and investors early on in the process becomes much more important than trying to bucket everything in during a testing the waters phase and then subsequent roadshow. But let's just think about prior to COVID, companies that would go on roadshows prior to testing the waters, it would be, let's say they would meet with 15 to 30 different investors, different portfolio managers. That's now increased to around 60 to 90, depending on the sector that you're in. And there's a really understandable reason for that. If a company is not hitting on every single cylinder that's important to an investor, just from a broad-based standpoint, like margins, revenue, profitability, and go down the road, there's a need to develop a relationship to rationalize why the company is not there yet and how they are planning to get there in the future, and establishing that in a very credible way. Investors, even though, dry powder is certainly more ever present, there is certainly a higher bar and a higher level of due diligence that investors are going to do, because to be very transparent with everyone, after 2021 and 2022 and into 23, when some of the IPO investments really that these portfolio managers made started to go south in a hurry, a lot of these, just from a personality and humanistic standpoint, like their jobs were at risk, and some did lose their jobs. And it represented basically a huge learning lesson for those that hadn't been through this environment yet, that they need to be a little bit more conservative or adapt. So how do you get beyond that? Well, going back to the humanistic element of it all, develop a friendship, a relationship, a baseline level of trust. You can't wait until your earnings calls to establish trust. So that's the first item that I would say. Secondarily, I would also just throw out there that the common refrain of certain, let's just stick with tech, for example, certain things that one needs to achieve before going public. For example, the rule of 40. we have data to suggest that, just from a very high level, so there's about 565 some odd technology companies publicly traded now.
Dan, you froze. Not sure if we lost you. Oh, you're back.
Oh, sorry about that, team. Sorry. So what I was saying is that like rule of 40 might not be the best indication. Back in, prior to COVID, we had about 385 companies that were publicly traded technology companies. They about 25% were, basically achieved the rule of 40, had a margin over 20%, and sales growth over 20%.
Oops. I think we lost you again. Dan, I think, sorry. Okay, you're back. No problem. No problem.
Yeah.
Did you want to finish your thought?
Just in a very short method, revenue rule of 40, not necessarily the hard won rule that it used to be. There's some deviation there.
All right, thank you. Shivani, getting a little tactical, what financial systems, controls, or audits are essential before folks file for an S1? Here.
Yeah, I mean, there's a couple things to really think about. I think the first thing out the gate is to figure out if you would qualify as an emerging growth company. I think a lot of companies going through the process do end up qualifying for it, and all that means is the year before you're going public, so you're a final year of financial statements, your revenue is no more than $1.2 billion. And if you qualify for that, then you could file as an emerging growth company, and that affords you a few benefits. One being that in your S1 filing, you only have to put 2 years of audited financial information in, which if you don't qualify as an emerging growth company, you'd end up putting 3 years. So that'll be one determining factor as to how much information you actually need to put into your S1 document, your IPO filing. The other thing is it does provide you some benefits in the long run too. So for a number of years, you're also able to adopt any new FASB standards along with private companies as opposed to public companies. So it typically gives you another 1 year to adopt standards. Now, I will say most companies try to match what their public company peers are doing just for comparability purposes, but it does give you a little bit of a window there. And then the other thing that does give you as well is it'll give you a 5-year runway after you go public to do your attestation on your internal controls. So you've got a little bit of a runway there. Now, that also is shortened if you end up having a public float of more than $750 million, which many companies do end up hitting within a year to two after they go public. Once again, it gives you a little bit more flexibility if you are a smaller cap company. Now, when you're thinking through audited financial information, what to put into your document, a lot of people think, well, I've been doing an audit for so many years. You possibly started doing it when you entered into your Series B or Series C financing rounds, and you've been doing it for a couple years prior to going public. Most likely that audit you've been doing is under private company standards or AICPA standards. So usually before you're actually going public, you'll need to do an uplift. So that means you as a company would end up having to go back with your auditor and re-audit some parts of your financial information to be in compliance with PCAOB standards, which is what's going to be required when you do file publicly. And I don't want people to underestimate the amount of time that could actually take. In some cases, it could be a really large uplift, and the last thing you want as a company is to have this be like the long pole in the tent as you're trying to go out to get the right financial information to actually to put into your document at that point in time. So I would suggest for people to start thinking, if you are 2 to 3 years out from where you anticipate doing a public offering, that you're having a conversation with your audit firm about if they can actually file with the SEC as public with publicly traded companies, because there's some firms that don't and are not able to, and then B, if they have been doing a PCAOB audit for you. If they haven't, that's one thing to go back and, like I said, start talking to them about the journey to actually get that done to make sure you're on the right track for when you do want to go and file an S1 document. From a control standpoint, I would put in the category of you need to be what they call SOX ready. So SOX being the guidelines to for your internal control structure. Now, you don't necessarily have to have all your controls in place, operating effectively and being tested, but you do need to have a control structure in place. You do need to make sure that your CEO and CFO are comfortable signing off that they don't have significant deficiencies or material weaknesses in their control environment prior to actually starting that process. And what that typically means is you should have somebody at least go through and do a SOX assessment and determine if you have large gaps in your processes and make sure that you have started to fill any of those high-risk gaps. There are a lot of companies that go public with material weaknesses. I think usually what people want to know, though, is have you been able to remediate them, and do you have those problems going forward? And I think if it's all in your back history, you're probably okay. If those are problems that continuously persist, that's where you're going to have problems, because the one thing everybody wants is to make sure that your financial information is complete and accurate and timely. And I think that's probably one of the biggest challenges when you do go public. It's that timeliness. With it, for public companies, you need to be able to essentially get your quarterly financial information out within about 45 days, year-end information within 60. So if your accounting department is not built to close the books timely and get the financial information to your auditors in that time frame, it would make things very difficult for you as a public company to meet your earnings timelines. From like a system standpoint, what I typically tell folks is if you have an overly flexible system that allows you to do anything you want, you probably have a material weakness on your hands. You shouldn't be able to book random entries. The CEO should not have access to your financial systems to do anything other than read data. And if you do have the ability to do all those things, you probably are in need of either a new system or needing to lock down some portions of that system so that you don't have an internal control failure for as it relates to your systems going forward. There are a lot of different systems that you can use, so I won't be specific to that, but you definitely want to make sure that you have a segregation of duties and that your financial information can't be tampered with on an ongoing basis.
Important information. Thank you.
Yeah.
For folks that may not be monitoring chat, please, if you could keep your questions in the Q&A section and any comments in the chat, that'd be awesome. So helps us stay organized. But Austin, for you, what should early stage companies be doing now, even years before an IPO, to kind of get themselves ready from a legal standpoint, or to avoid any friction later?
Yeah, so there's a lot of work that can be done ahead of drafting an S1 and ahead of the org meeting. And there's a lot of preparation that should be done, frankly, in the 24 to 18 months in advance of when the company wants to go public. Similar to the audit function, there's a lot of legwork and a lot of prep that goes into this process that everyone needs to have, eyes wide open about going into it. There are a few different kind of key work streams that I think people should kind of have on their radar. The first is due diligence. Every company has its own skeletons in the closet, so to speak, or what I would call sensitive disclosure areas. It's important to understand what those are and make sure that everyone kind of goes into it understanding that those things will probably be disclosed. And if things need to be corrected or improved upon so that you're comfortable with the disclosure, that needs to be handled in advance. You need to make sure that there's an appropriate regulatory framework and compliance program in place, similar to the audit. There's, underwriters are going to want to understand what processes and procedures are in place to comply with law, so that you don't become public and then 3 months later finds out that your entire systems are not compliant with FCPA or something like that. There's going to be a very large data room that a bunch of people are going to need to review as part of this, and starting to pull together that information into a consolidated source, even if it's not, publicly or put into a formal data room, but having it all in kind of one place so that at the appropriate time you can populate that data room with all the relevant information. That's important kind of prep work. And then, all the statements that you're going to be making in the S1 and in the roadshow, those are going to need to be supported. And so if you've been saying publicly, we are the first to ever do this, or we are making the most of something, you need to have support for that. And sometimes people, looked up something relative to a market source 3 years ago and they have no idea where it is. And so starting to think about and compile that backup information is important. As well as, if you've been around for several years and you've got employees who have grants and other issuances and financings, it's important to make sure that the cap table all ties out and that everything's been approved at the right time. And if you need to clean that up, you want to get that done before the org meeting so it doesn't cause issues in the back end. Additionally, from a corporate governance perspective, whenever you're preparing to go public, if you've got a set of founders who have a significant set of control and they want to retain that control as a public company, you want to consider things like a dual class or multi-class structure so that those individuals post-IPO continue to control a significant majority, whatever the right structure is for the company, number of board seats. And that requires kind of planning and thoughtfulness, not just, from a legal perspective, but also with your investment bankers to understand what the market will be willing to accept. And so kind of sketching out that structure and making sure everyone's comfortable with how that'll work is important at the front end. And then, to go public, you're going to have to go and get a bunch of approvals, both from the board, but also from your stockholders, understanding, what those processes are. And if you've got a material contract that you're going to have to file and the contract says that it cannot be publicly disclosed, you're going to need to go out and talk to your counterparty to make sure that can be publicly disclosed in connection with the IPO.
Yeah.
From an employee compensation perspective, there are several different ways you can kind of get ahead of that work stream. You can consider transitioning from options to RSUs so that there's not a big tax hit and there's like long-term gains where you got to exercise the option before you can sell. You can consider topping up grants to the key executives and founders so that everyone's incentivized to stay with the company and grow it long term. If you're making grants as you're going along the process from a 409A perspective, as you get closer to going public, you can't rely on the illiquid pricing as much as the closer you get to going public. And so, because then if you grant options at a super low valuation, then the SEC may come in and say, you have a cheap stock issue, you need to disclose this, you need to take a comp charge. And so having a good 409A, an updated 409A as part of the process and throughout the process is something that everyone should be kind of mindful of. And then, from a financial statement perspective, as Shivani was saying, there's a lot of work to do there. You got your PCAOB uplift. You need to make sure that if you've acquired any companies recently, if they're significant, you may need to get audited financial statements from those, which can delay the timing if they're otherwise unavailable. From a board and management perspective, you want to make sure, as a public company, generally speaking, you're going to need to have a majority of independent directors. And oftentimes, a lot of people who are serving on the private company board may not want to move over and transition to being a public company director because there's additional liability, there's additional disclosures. They just may not want to do it. And so having those discussions early to make sure that you've filled the necessary independent seats, but also that you have the right areas of expertise and qualifications, for example, service on the audit committee. You need to make sure that those conversations take time, and finding the right board is important to the long-term success of the company. And from a management team perspective, there are a couple key functions: CEO, CFO, general counsel, controller, that are kind of table stakes for being a public company that's successful, because you need all those people generally to have some sort of experience as being a public company executive. It doesn't necessarily mean that everybody needs to have it or that they've got extensive experience, but there are a lot of rules and regulations that are associated with being a public company, and you want to make sure that the key members of management have that experience. From a comms and IR perspective, there's, you want to have an IR team that, an investor relations team that is ready to talk to the street and has refined the story. And, whenever you're public, you need to have that function ready day one. And so working backwards, that can take several months to get the right folks in place. From a disclosure perspective, you're going to have to be disclosing to the street not just your financial results under GAAP, but also you're going to have to figure out what your key performance metrics are going to be. And so if you say, at IPO, we want to be able to disclose that we have achieved X users, or we've sold X widgets, or we have Y clients, or whatever it is, you need to make sure that, working backwards, that stat reflects up and to the right, quarter over quarter, period over period, and you're able to calculate it consistently, and that it's properly defined, and that, it can be audited if needed be, not necessarily by an auditor, but by the company, to make sure that it's accurate and complete. And so that takes time, because if, you don't want to get to an org meeting and the banker says, well, we think this stat is the thing that people are really going to care about. And one, you can't pull it together. And two, it doesn't look that good because you haven't been focusing on achieving that metric over the past 2 years. And then I think the last thing that you can think about, kind of getting prepared, would be setting a good timeline. So, everyone needs to go into the IPO process understanding that while the timeline may not actually be hit, it's important to understand how many months it takes, when your key individuals are going to have to be involved. Like, when is the CEO going to have to be engaged versus when is it more of a legal work stream? And setting that timeline in advance can make everyone's lives much easier. Now, obviously, to the points we were talking about earlier, as Dan was talking about how, timelines are being shifted back a month for factors entirely outside of the company's control, things are going to change. But setting a timeline in advance can be really useful to making sure that, the trains continue to run on time.
Right. And Shivani and Dan, if there's any, I'm pretty sure your roles intersect, all three of you, at some point. So if there's any best practices, anything else that you'd like to chime in with anytime, please feel free for any of that.
I just had one thing. I Austin made a bunch of great points. The one I did really want to emphasize is how important it is to think about your board and your management team early, because those roles are not easy to fill. And if you have certain people in mind for those roles, a lot of the times they even have to work out their own schedules to possibly come off of other boards, or rearrange things to make space. So you do want to start having those conversations early. And you also, even though you need them when you're public, you want to make sure the management team all jives together. You understand what the needs of the board and the audit committee members are. You don't want to do that your first day out the gate as a public company. So you want to make sure you're trying to build that muscle over a couple quarters. So it's not brand new to everybody, and what everybody's expectations are. So I really would not underestimate the amount of time it takes to get those in place. And I also think if you are looking for board members, definitely leverage, your audit firms, leverage your legal firms. They typically already have contact with so many potential independent directors that they can give you references as you're thinking through how to build out your governance structure.
Yeah,
Right.
I would just throw two factors for consideration. One, please just hire Austin and Shivani. I've actually worked with both them and their firms on numerous occasions, and they are phenomenal. So that's step one. Step two, Shivani is very wise in pointing out the board consideration. I'll just speak anecdotally to that. We look at data that suggests that the tenure of a CEO, and to a lesser extent other C-suite members, is directly correlated with the amount of time and due diligence that they put into, selecting their various board members, specifically chairman or audit chair. Just as a quick reminder, a lot of companies that go public wait until the last possible minute, thinking that the supply of board members are it's ever present and very robust. The supply demand dynamics do not work out in a company's favor, full stop. And the last thing that you want to do is rush that process, because, again, just to reiterate and put this in neon, they will ultimately be your boss. And if you do not vibe on every single emotional spectrum or business spectrum item, there is likely to be a not too distant future scenario where you conflict with them. And if that board member can somehow gain consensus with other board members, it's likely that you will be out as CEO. So it's really, really, really important. So listen, again, hire Austin and Shivani and listen to them. They're really smart.
Awesome. Well, just quickly, we can stay on the topic for 30 more seconds, double clicking on what are some of the best practices? Is there an ideal number from a board perspective? How many board members should you have from as you're recruiting them, or skill sets? Anything that's top of mind for you all? Any advice?
I'll jump in. So there are legal requirements. So again, for most companies, you have to have a majority of independent directors. Oftentimes you have the CEO who serves on the board, and typically there's one person who is not independent for one reason or another. The actual number of directors is really company specific. Larger, more established enterprises have 10, 12 directors, but kind of smaller growing companies, you might have 7, 8. You just need to make sure that from a practical perspective, you have enough independent directors to service the functions that are required under NASDAQ rules. So, for example, you need an audit committee that's comprised of at least 3 people who have the requisite background and skill sets and meet the heightened independence requirements for service on the audit committee. You also need a compensation committee comprised of at least 2 individuals who also meet the heightened independence requirement. And generally, there's a nominating governance committee that is comprised of solely independent directors. Now, you can serve on multiple different committees as an independent director, but it is too much work oftentimes for one person to serve on every committee, or even perhaps 2 of the committees, especially if you've got audit, which is a lot of work for the individual serving on that committee. And so you want to make sure that you've got enough directors who provide the requisite skill sets and expertise to benefit the company and help the CEO and executive team kind of deal with the challenges that you'll face as a public company. But you also want to make sure that you're not going to be overworking your directors so that they can't provide that meaningful advice and oversight whenever they're on the board. So it's a delicate balance. But to Dan's point, it's important to make sure you do that work early, because you want to make sure that the personalities in the room all kind of work together and are all rowing in the same direction.
Yeah, and I wanted to point out, and thank you, Austin, for bringing up the specific rules. And you nailed it. When you go public, you only actually need the fully formed audit and comp committee, like Austin pointed out. You can backfill other board members up to 6 or so months after the IPO. And just that gives you a little bit more time. Just as a shameless plug for NASDAQ, we actually have a group called the NASDAQ Center for Board Excellence. And this is a complimentary and free service for growth stage companies that are on the cusp of an IPO that are looking for board members. And effectively what this group does is go into our network, public filings, and the like, to create a roster of independent directors that fit the criteria that companies have of what they're looking for, and then bringing a select but ideally potent group to them, and make introductions if any of those seem to be a fit for interviews. So in the event that might be helpful to anyone here on this call, would love to help out. But yeah. Thanks
for sharing. We know where to go now. All right. Dan, staying with you for another minute. And in the spirit of, I would say, kind of the checklist from a NASDAQ perspective, what does the listing process look like? And what are some top of mind kind of things or checklist items? What should people expect?
Yeah, so thankfully this is not a very large list, and it's not too heavy of a lift. So procedurally, the 2 things that we recommend are just baseline things that must be done. The first step is the NASDAQ listing application. So when do you file that? Well, I would typically wait until after your draft statement with the SEC has been filed, because our application process, more or less, is a copy and paste type function from what you put together in your confidential filing. So it just makes, Austin and his team's job easier if it's done at that point. Then there's the, comp committee and audit committee that we just mentioned. That's a component. And then third is the development of an investor relations website to align with regulation fair disclosure. So you don't need to have that up prior to IPO, but definitely on the IPO day, you need your IR website up with a whistleblower hotline to conform with that SEC regulation. And just going back to Austin's point about starting the IR process early, and from an outside counsel standpoint, like, first, find your auditor, find your counsel, then move quickly on to IR. What's interesting is that a lot of IR firms now also serve as what are known as IPO advisors. And IPO advisors are interesting in the sense that they guide, counsel, and serve as a traffic cop for all of the different parties that are external that you're hoping to engage with in the capital markets, bankers, analysts, investors, and so forth. And they kind of sequence the process out to make sure that, CEO, CFO, and the team can do their day job and this project in a way that doesn't make their head explode. But what's even more interesting about them is that they actually are not paid directly by the company. They actually take their fee from the banker economics. And so, and this is a very well-trodden path of, advisors in the ecosystem where banks will and do expect someone to play that role. So it's not as though you're inserting any type of disruption into the personal dynamics. So I would just say, like, talking with IR advisors, IPO advisors, and we're happy to provide a list of the ones that we work with pretty consistently. It really, just Austin's point, just really helps later on in so many different facets. The other thing that I would just say as a necessary step, but it's not necessarily a NASDAQ step, but it's one that I would really encourage everyone to think about. Once you start going through the process of getting ready to go public, finding someone internally that can handle internal comms, that's really, really, really important. It's not just helping, employees kind of get the right message and the right themes. Of course, that is a part of it. It's actually a liability mitigation effort. So when you go public, as Austin can attest to, there are going to be myriad rules that employees need to adhere to in order to not step afoul of SEC regulations, right? And they are not entirely, arcane to the point where they wouldn't understand it, but there are always at the margin employees that, for either intent or just accident, they test the boundaries. And having someone internally to reinforce certain regulatory communication items is important. And I'll tell you that a lot of companies in the 2021 IPO bonanza didn't have that. And that contributed to a lot. And a good example is like when IPO lockup expiry, occurs, there's a lot to be said for internal comms to say, yes, you can certainly sell on this date. However, let's keep this in perspective. If you and everyone else sell on this day, your equity at large will probably be lower than if, the majority of employees held, and just trying to help them understand that dynamic. It could be something as simple as that. The companies that do actually do that, we work with a number of pre-IPO companies that are going through process now that actually have, and it was one of their first hires in the process, has been massively helpful in mitigating what we would consider aberrant or bad behavior by employees. So just something else to think about. Just from a timing standpoint, the NASDAQ application takes 3 to 4 weeks to process. The investor relations website takes about 6 to 8 weeks to develop. So just budgeting that into your time frame.
Great. Awesome. All right. As companies are thinking about like scaling and growing their teams internally, what are some key roles? And Shivani, maybe I'll start with you. What are there some best practices from growing like internal finance teams pre-IPO as they're
Yeah,
getting
I mean, there's some key roles that you definitely want to be thinking about. If you are a revenue generating company, I would say pretty early on, you do want to make sure you have a strong director of revenue that understands your business model. I can't tell you the number of times that I've had companies start wanting to discuss going public, and then they realize that their accounting for the revenue is incorrect, and all of a sudden it's net accounting versus gross accounting, and you get like a 50% haircut on your revenue line. Like that can very quickly like dash any IPO hopes that you might have. So early on, making sure you've got somebody in that understands your business model, can get to the right accounting conclusions on your revenue model, is really important. And can pay dividends in the long run. You definitely need to have a controller in place as well. That'll just help to make sure you can timely and completely and accurately hit your financial reporting timelines. Down the line too, definitely thinking about like a technical accounting and SEC reporting function. So team that can really be on top of any new regulations that are coming through. If the company is doing transactions, can appropriately account for it, and then can pull together your document once again on a timely and accurate basis. I think the other role that tends to get almost forgotten about until too late would be your stock administrator role. I can't tell you how important that is going through an IPO process. The number of times people are going to be asking for a cap table or option information or SU information, and then once the transaction actually goes through, having to do all those communications that Dan mentioned, and make sure that everybody understands what their share counts are. It becomes extremely important, and that gets really difficult down the line if you don't have somebody that's already intimately familiar with all that data. Also down the line, you'd also need to consider a head of internal audit or some function to support from a SOX preparedness perspective. And then depending on how complex your business is, you might also require a different level of like tax assistance. So you might be outsourcing for a period of time, but it's always helpful to have somebody in-house that understands, once again, your footprint and what the potential tax consequences are of some of the things that your company might be undertaking. Now, that's on the accounting side. I think on the finance side, you definitely need to have a FP&A team that's strong and one that can produce forecasts decently well in line with the company's expectations. One of the biggest issues that you're going to have going out the gate is if you're not able to meet your forecasts and do like a standard beat and raise on a regular basis, that's the number one reason your stock price is going to fall after you go out. So making sure you've got like a really strong FP&A team that understands business, works with your CFO to make sure that you've got, like I said, that very consistent beat raise would be really helpful for an organization.
Right. Austin, or Dan, anything on the legal front or any other roles that come to mind?
Yeah, I mean, from a back office perspective, there's a facelift that typically comes as part of the IPO process. And that is not to say that, your existing people can't do the job, but there's just a lot of new rules and regulations and considerations that come with being a public company that, you want to be mindful of when you're thinking about putting together the right team. I totally agree with everything Shivani said. There's a lot of people you need to hire typically from a financial reporting perspective. And your FP&A team is crucial to the company's success. If you're not able to budget and pull together, projections that are pretty consistent and accurate, you're going to have a lot of trouble, working with the street to make sure that you are hitting the results that you are setting for yourself. And that's something that, good public companies hit the ground running day one and ready to go. There are some additional roles from a legal perspective. You got to have somebody who's the chief compliance officer, whether that's your general counsel, whether that's your CFO, or even somebody who's internal legal who's hired specifically for the role of overseeing compliance matters. That position is a prerequisite for maintaining your compliance as a public company. And so you want to make sure whoever that is understands, what the rule is and how best to administer that function. From some other perspectives, you've got financial reporting, like you've got the CFO. You need somebody who's ready to talk to the street and who is a public company CFO, because being a good internal CFO is a very different exercise than being able to speak convincingly to the market on your earnings calls and respond appropriately to investor questions at conferences. And so the person who, it doesn't necessarily mean that you need to have somebody who's a CFO who is a public company CFO, but it certainly helps because there's a lot of considerations that you don't know about until you've gone through the role before.
Right. Dan, anything to add? Or
The head of SEC reporting has been highlighted by leads that I work with as a position that they wish that they had hired well before the IPO. For what it's worth, it's hard to find those folks. I would take a look now and just really work on that. There are specialized accounting firms that can definitely help you with that. But the sooner that you can bring someone in-house, the happier you will be.
Yeah, I probably will say the cheaper it'll be for you.
Yeah.
Because if you're hiring a bunch of consultants to come in at the tail end of your IPO or right in the middle of your IPO, your rates are probably going to be higher, and there's going to be a lot more compressed timelines, which is going to just suck up time, and you're not going to have somebody that can plug in after the IPO right away. So there's also going to be the transition time post-IPO, so it'll just inevitably be more expensive for a company.
Yeah, and just to add to that, if you've got the right folks internally, that can really reduce your reliance on outside counsel, your auditors. If you're engaged a third party to assist in the preparation of the financials, the more of that you can bring in house, the less sticker shock you're going to have when you get the bills as part of this. Because as I'm sure it comes as no surprise that the IPO process is not inexpensive. But if you are able to get the right folks internally in advance, that can help offset some of those costs. Now, obviously, your G&A will be higher because you have these internal bodies. But if you say, we're going to go public in the next X years, regardless, then getting those people butts in seats early can be really helpful for continuity of care and keep the cost down.
awesome. Right. Well, there's a question that came in. Is there a checklist or a list of processes that people can find somewhere? Or do they have to? They should come to you, I would say, right? Too.
Yeah, there's a checklist for almost everything, but they're tailored and bespoke to whatever the company's situation is. But there are checklists, but I don't know if I'm not aware of any third-party checklists that are super relevant. It just depends on what the company's going through.
All right, cool.
Yeah, I'd probably suggest if you already have an engaged auditor, I know for like my clients, for example, if we know they're looking at an IPO, we will already go ahead and do what we'd consider to be like a mini IPO bootcamp tailored to the company to be able to identify what things need to be done. And we usually do it alongside the attorney. So I've done them with like the Wilson team in the past too.
Right.
So
Yeah,
definitely
totally.
talk to your auditor if you're on that path.
Yeah, your counsel should be able to pull together a checklist pretty easily.
Awesome. Great. Well, I think we've answered quite a bit of topics, but are there any, do you have a list, or what's one thing that you wish more founders asked before their IPO journey? Is there anything that we've left out that you feel we haven't covered?
I mean, I think from my perspective, I think a question that everyone should have an answer to is, why am I going public? There's so much work, there's so much cost, and going public because you want to be a CEO of a public company is not like a good reason to go public. There are a lot of good reasons, giving access to liquidity to your investors and your employees, being able to access the capital markets, increasing your brand awareness. Those are all great reasons to go public, but just going public for the sake of going public is not a good reason. So I think going into it saying, okay, these are the benefits that we see from being a public company, and that's why we want to execute on this transaction.
Yeah, that's a very important question for sure.
Yeah, 100% agree with Austin, especially in the markets we're in today. Sometimes like an M&A might even be better depending on what you're looking for as a company, or even staying private, right? There's a lot of dry powder from what JP was saying. So
Well, that's another thing. You need to hire Austin, Shivani, and perhaps Dan to advise you on. All right, Dan, go ahead.
No, I would think, first off, as a company, before you go public, perform as if, do mock quarterly earnings calls, go through those steps and just get that type of muscle memory down. But as CEOs and founders, you really do need to have a very deep discussion with yourself, advisors, and board members to identify, okay, is my CFO the right one? Is my CMO the right one? Go down the line and don't do it, when you just filed confidentially. This needs to happen at the outset because anecdotally, we are working with several companies right now that mid-process decided to bring in another CFO. Now, sometimes that's just going to happen, and we understand that. But even beyond just the disruption in workflow, there is going to be a desire of someone of that ilk, coming into like a CFO or CMO role to basically establish their own view of the world on the company. And it's probably going to deviate from the previous officer. And that's going to be emotionally, intellectually difficult for the company. Not something that you can't get over, but it'll be really hard when you got a lot of other stuff going on. And we've generally seen that process not turn out well. So once you decide to start going, great. Please have a conversation with yourself, pour a glass of wine, and just have that internal dialogue about if that is the right thing and you have the right people around you.
Great. Again, I think we've spoken about most of it, but there's another question in the chat, which speaks about what are some of the key deal breakers or reasons companies wouldn't be successful? Anything else that comes to mind other than the things that we've spoken about?
Well, one of the items that come up that will invariably touch all companies in some capacity is what your existing investors and the investors that you have in your cap table that do at times play in the public markets and have the capability of doing so. How are they viewing your IPO? Will they buy into it? To what degree? And how will they signal to the markets that they're having confidence in you? Because whether or not a portfolio manager that has yet to take a position in your company, will think about your company. One thing that they will look at is how do the existing investors, the one that have the most up-to-date and relevant information that I don't have, how are they participating? Is this deal fully constructed around them, or so on and so forth. So yes, you want to go out and find new investors, but keep in mind that you need to make the existing investors, happier as time progresses, as you approach that time, because they're going to be a huge litmus test for how you bring in new investors.
Yeah, there are a lot of things that can go wrong in the process. You've got officer transitions. You've got, as you're going through your PCAOB uplift, you realize something was accounted for incorrectly, and now you've got to restate your financials, or you've got a material weakness. You get hit with a lawsuit. You have some sort of regulatory inquiry from some sort of a governmental body. There's a lot of things that can go wrong that are outside your control, and but it's really important to execute on what you can execute on as well as you can, and putting the right people in place and thinking about things in advance so that, if you know that this is going to be an issue in 6-12 months, you can start preparing for it now. And so that's why it's pivotal. And I realize this is somewhat self-serving, but it's really important to engage with your advisors early in the process, because, they can help you see around corners that you might not even realize are corners. And so it's, if you engage with folks early, you can identify those sensitive areas, those areas where there's risk, and start planning for those in advance.
Right. Well, I would love to continue the conversation, but I think our time is almost up. So maybe I'll wrap us up with one last question. Any forecasts? Like, what do you see in the next 12 to 24 months from a capital markets perspective? Dan, should we start with you?
Yeah, I would. There's going to be a good amount of uncertainty through the end of the year that's going to give companies pause to go public, but you will see the quality and the ilk of companies, even in a recessionary environment, like continue to advance. I mean, there's an incredibly strong cohort of companies that are ready to go public. And that's only going to compound given more time. So it's only a matter of time before the well begins to break and or the dam begins to break, and I can't wait for that.
Austin, anything from your perspective?
Yeah, I think that, to Dan's point, there are, looks like we lost Dan. To Dan's point, I think there's a robust pipeline of companies that are ready, willing, and able to be public. You want to go out at the right time. So when the right time is, who knows? But I think there are going to be also some going public transactions that aren't traditional IPOs in the form of de-SPAC transactions. I think that, after the initial wave of de-SPAC transactions where, a lot of investors got burned and you got a lot of underfunded public companies, I think that there's still an investment thesis that makes sense for certain de-SPAC companies. And so, and there's a little more certainty on the front end that transaction can get done relative to an IPO where you might work for 2 years and get to what you think is the finish line, and there's not, something happens in the market and you're not able to price. So I do think that there's going to be some renewed interest in the de-SPAC transactions. I don't think it'll be to the level that we saw in 2020 or 2021. But I do think there will be some more interest in the market in those types of transactions over the next year or so.
Right. Shivani?
Yeah, I would agree with both what Austin and Dan had said as far as the timing for when the markets might open. What we are seeing is companies taking advantage of the fact that they've got a little bit more time and actually building up their infrastructure to be ready to go public. And I think, when the markets are slower like this, or there's some uncertainty, being able to give yourself the time and build that runway so that when you do have the opportunity, you're ready, that's all the better. So I would think about it more in terms of, well, maybe it's not this year, but if you can build your infrastructure so that next year you're ready to go, that would make your life a lot easier as a founder, CEO, or CFO in your role.
All right, wonderful. Well, thank you both, and Dan. Sorry I didn't get to thank Dan, but appreciate your thoughts, insights, and comments, and thanks to our audience for being so engaged. And I'm going to hand it back to Colin.
Thank you, Suchi, for leading such a great conversation. Everyone was typing in the chat. These are all great questions.
Awesome.
And Austin and Shivani and Dan, who lost to Zoom land, thank you so much for sharing your insights and joining us for the time today.
All right. Well, thanks all.
Thank you.
We're going. Oh, yep. Thank you all so much. To those on the call, before we transition into our next session of the day, executing your IPO, we're going to take a quick break so you can refill your coffee cups and take a short break. We're going to return shortly, so we'll see you in a moment. All right, all right. Welcome back, and let's transition into our next panel, executing your IPO from the roadshow to the bell. As you get settled back in, we want to get a better idea of what you're interested in learning about and who we have joining. So in this quick poll, I'm going to launch, which is in the next 12 to 18 months, are you planning on starting the IPO process? Headed in that direction, yes, but not within that time frame, or not quite yet. Let us know. This will help inform our panelists on where you're at. So thank you for participating in this poll. I'll let this run for a little bit. Thank you for participating. Alrighty. Well, I'm going to share those results. Looks like it's a decent mix between headed in that direction and not quite yet, and then some folks just not within that time frame. So thank you for participating in that poll. So without any further delay, please join me in giving a warm welcome to our next group of experts. We have our moderator for the conversation, who's Mariah Argueta, who's a managing director at NASDAQ. We have Sherry Major, who's a U.S. National Capital Markets Readiness Leader at KPMG. We have Victor Nilsson, who's a partner at Wilson Sonsini. So glad to have all of you. And Mariah, over to you.
Hi, happy to be here. So excited for today's panel. I'm Mariah Argueta. I'm a managing director on the new listings team at NASDAQ. So my role here is to work with private companies as they are preparing for a potential IPO. Actually, we try to engage way before that as well. So again, excited to have this conversation with the panelists, and I'll let Ms. Victor, you can introduce yourself next.
Yeah, sure. Thanks for having me. I'm a corporate partner here at Wilson Sonsini, based in our Seattle office. I've been a corporate securities lawyer for a decade now, focused on IPOs and public company representation, primarily corporate governance. Thanks for having me.
Barry?
Yes, thanks for having me. Hi, everyone. My name is Sherry Major. I'm a partner at KPMG based in the Bay Area, and I lead our capital markets readiness practice for the firm here nationally in the US. So we help companies with the requirements of getting ready to go through a capital markets transaction and getting ready to be newly public. My background is in accounting and reporting, but KPMG brings a breadth of expertise across audit, tax, advisory, basically everything that a company needs to get ready for that important step of their journey. Thanks for having me.
Fantastic. And John?
Great, and great to be with everyone. John Halleck. So I've got about 25 years of experience in corporate communications, investor relations, all in the healthcare services and IT sector. I've been fortunate to be part of teams that have done 3 IPOs. Big fan of NASDAQ, and Victor, your team there at Wilson, they were on our last one there at Livongo. So very excited to be part of this conversation, having lived it a number of times, and meeting you, Sherry, as well, and Victor.
Fantastic. Awesome. Great. Well, we have a bunch of questions to run through today, so we'll just kick it off. I guess to start, the first question is addressed to the entire panel. So we'd love to get your thoughts on what makes a successful IPO roadshow in today's market, and also how has that changed post-COVID?
Well, maybe I'll start. I think one of the important things that has evolved over the last few years is that companies are really testing their story much earlier with investors. So think, 2 years before an initial public offering, they should be starting to take meetings. And we're seeing, I think, an increase in the number of meetings that companies are taking. And really what that has shifted to is that by the time a company gets to the roadshow, investors should already be comfortable with the story, really know the company. And I think it changes the discussion in the roadshow to maybe be a little bit more focused on valuation than really just introducing the company and the business model. So that I think is a pretty significant shift that we've seen over the last few years, and probably was driven, by COVID and by the ability to take more meetings remotely.
Yeah, and to add to that, I think what is true today and what has been true pre-COVID is, right, you want a clear, compelling story about your business, and to Sherry's point, you develop that as you're taking meetings and taking them well before the roadshow, for example, through the testing the waters process. Through that process, you'll also learn to anticipate and proactively address investor questions and concerns, so that, as you keep getting the same questions, when you actually get to the roadshow, you've already heard it all and you hit it sort of right on. And then to comment on what's changed since COVID, I mean, one big change is we've really in a virtual first or more hybrid format for your roadshow. So it used to be, right, all in person, management team flies everywhere, to a much more efficient, generally Zoom based with some in-person meetings, and typically shorter, right? Where we used to see 2 weeks, now we're down to 4 or 5 days. That's a big change.
John,
Yeah, I would
anything?
say I'll chime in real quick, and I think Sherry hit on something. If you've done it right, and I tuned in for the last few minutes of the last panel, whether that's through media, private company investor conferences, you should already have really good mind share with the investors you're going to be meeting with on a roadshow long before that actual roadshow, whether it's virtual or in person. And that's a real commitment of the management teams. It's not just as much of, do we have the right people in the right spots at the company, but I think when companies start to understand the demand of being committed to investor relations, or even on the PR side and some targeted campaigns prior to going public, that's the real the real bandwidth suck that you're going to see, and you got to get committed to that rigor.
Yeah, no, I think those are all great points. We definitely see that on our side as well, where companies are meeting with investors. I think, Sherry, you were saying, 2 years ahead of an IPO. And a lot of it is that consistency in the story too, right? Telling their story and then meeting again with investor, and investors using that to kind of verify, like, are you doing what you promised you were doing? And that's how they build trust. And again, so then during the testing the waters, they already know the management. So it's just sort of diving into the IPO bit of it. So fantastic. Great. Well, Victor, let's move a little bit to sort of SEC, right? So what are some of the most common SEC or legal hurdles that come up right before a filing?
Yeah, great question. So you definitely want to manage your timing relative to staleness of your financial statements. That's one, wouldn't say hurdle, but something to keep top of mind, and Sherry can comment on this too. But essentially, right, your financial statements can only be so old at the time you execute the offering. So here we are thinking, we're going to do this roadshow in this period of May, and all of a sudden we're running up against staleness, and now we have to prepare updated financial statements. And obviously there's a timing aspect to that, and keeping that top of mind. Late stage changes to the business, your pricing, your KPIs that are coming up, because it just happens as you've been refining the story, that can slow things down, because the SEC is going to look for transparency in your disclosure, make sure there's no material misstatements or omissions at the end there. And then maybe generally, but I mean, it goes to legal hurdle as well, is making sure you stay consistent in your messaging between your S1 and your roadshow deck and what you're actually saying during a roadshow presentation, so that you don't have a footfall right at the end. That's a good legal hurdle to keep in mind.
I might add on too that one of the things that companies can do is, as they're going through the SEC comment process, there are some topics that the SEC asks about all the time and that companies can anticipate and prepare for. And so I think if companies have given some thought to where the SEC might have further questions, and they've already essentially documented their conclusions and their positions, if they do get a question, they're able to answer that very quickly. So that just helps keep the process moving, maybe help stay away from some of those staleness dates that Victor alluded to, and really just helps the company be in as strong of a position as possible to get through that process quickly.
Definitely. It's interesting you're just talking about SEC comments. I was hearing recently that they are giving a lot more comments around AI because a lot of companies are incorporating how they're using AI into their business, but not necessarily thinking about the risks and the kind of guardrails that they're going to have to put in around that. So if you're putting in stuff about AI and how it's impacting your sales, you ought to have to think about how you're investing to protect the company. So I thought that was an interesting newish development.
Absolutely.
Fantastic. So John, moving to you. Could you walk us through what a company can expect the week of their IPO from pricing night to the bell?
Yeah, no sleep, none. It's a wild week, as you can imagine. And it's when you're doing the IR and the comms, there's a bunch of different masters, right? So you're just coming off the road show, and I'll just use Livongo as the most recent one. So we increased the price 3 times on that road show. Demand was ridiculously high, and we had already done months and months of media and investor education. So we were absolutely going to try to use that as a branding moment. So the week of the IPO, you've got a large contingent of the team already in New York. In the case of NASDAQ, they're kind of hunkered down there. And some of it's a little anticlimactic, just speaking from my point of view in the position I'm in. Everyone's having a good time, and you're in a closet waiting for the good lawyers at Wilson to give you a number and to send out a press release at 11 o'clock at night. But if you've done it all well, and again, hats off to NASDAQ and the other teams, then once that's done, you have things already in queue for the next day in terms of activation and press, and whether you're doing CNBC and all of that. But you should be prepared for pivots. You should be prepared. You're dealing with legal teams, you're dealing with the banks, you're dealing with your own employees and internal comms, right? There's weeks of, it's often overlooked, not probably by the folks on this panel, but from companies, of understanding the cultural impact that this is going to have on your teams. And you're going to have multiple locations. You're probably going to have, in the case of NASDAQ, right, they've tricked out your California office, your East Coast office, your Midwest office, right? And you've got people there. And so there is a really tight deadline of things you're trying to do on top of this almost anticlimactic moment where you think the bell opens and there goes your ticker, and that doesn't happen, right? You're waiting as the market's being built. So pacing yourself, right? Because you have these adrenaline spikes, and so not getting too high or too low, and leaning on the experts. In the case of Wilson, I can't speak highly enough for them as a firm. They were a partner. Was the earlier question that you all brought up of, when you're a high-profile company, for instance, in the press, you have to go to your legal team long before that and say, here is what I want to do in the coming months. Show me the line, whatever that, and by the way, they're going to make the line like here, but show me the line, and I'm going to put my tippy toes right up to that line, and getting them comfortable. And what a lot of companies I've seen do is they either don't include their legal team, or, what Sherry was talking about, from the accounting standpoint, they don't necessarily understand the timing of things and numbers and staleness. And then you find yourself either, and okay, we need to be quiet now because we didn't bring everybody in, and then the legal teams and the accountants say just be quiet, and so you end up not getting to do what you wanted to do from a brand external comm standpoint. But if you had brought them in much earlier, you'd be amazed at how lawyers actually are very flexible within the confines of the law, saying, no, you can do these certain things, and here are the things you need to think about, and making them a partner in that, as opposed to looking at them as the fun police. I think they're very fun.
Thanks, John.
Yeah.
I think Victor's very fun. Thank you, John. Just speaking of sort of the messaging and how you're tailoring that, and I guess thinking it from a legal perspective, Victor, how should companies tailor their messaging for investors, institutional investors, and the general public?
Yeah, it's a great question. I mean, so the way to think about it is your roadshow and your lengthy S1 registration statement that you file with the SEC, which includes the prospectus that you give to investors. They really bridge both audiences, and so there's going to be parts of that that are really more plain English to the general retail community, right? If you will, like, here's our growth story, here's something on our brand, right? Here's sort of more generally, but there's going to be sufficient detail in there as well for the institutional investors, and your roadshow meetings will be with institutional investors where you'll have a chance to double click and go deeper and really hammer home on the details that they care about. And so you're highlighting different aspects. It's all the same story, it's all the same disclosure, but you're sort of highlighting it in different details depending on the audience you're addressing at the time, right? And so, yeah, I mean, institutional investors are clearly going to care about, long-term strategy and what, if you're not already profitable, what is your path to profitability, right? What are some of the really metrics? How do I model out this business? And obviously, retail investors have different considerations in mind. So,
speaking of the kind of like the metrics and the financial disclosures that you are going to include in your S1 and share with investors, Sherry, do you have a view on like which one of those companies should really be focused on?
Yeah, absolutely. So maybe thinking first about financial disclosures. So companies need to be aware that there's a difference between what they probably had historically in terms of AICPA financial statements and what they need from an SEC perspective and being compliant with the PCAOB requirements and the SEC requirements. So there is definitely an uplift that's needed to the financial statement disclosures. And I don't think that effort should be underestimated. And then I think thinking about the KPIs, so it's very important, I think, to benchmark, your company against your public company peers, because you will find that there will be a set of KPIs that get disclosed probably relatively consistently based on the industry. And so you want to compare what are the metrics that you follow already internally that are important to how management runs the business? And are those the same or different from what your peers are disclosing? And there's an effort, I think, to think about aligning where that makes sense. So you don't want to have KPIs, you don't want to disclose KPIs that aren't really meaningful to the organization and to how you view the business just because a peer does. But it does help investors, with comparability and understanding how different companies compare. So I think it's important to know what's relevant to you as a management team and running the business, what's important to your industry and your peer set, and what are the kinds of metrics that you want to disclose on an ongoing basis, because you set the stage in your S1 as to the kinds of disclosures that investors and regulators are going to expect to see on a regular basis in your, quarterly and annual reporting. So I think it's very important to set those upfront and be really thoughtful. You don't want to have too many KPIs because that gets hard to manage, but you want to really focus in on the key ones that really are how you manage the business. And then I think the other thing I would just add is the important thing about KPIs is really thinking about, are they non-GAAP metrics that you're wanting to disclose? And if so, there are SEC rules around explaining how a non-GAAP metric relates to a GAAP metric. And so being mindful of the SEC rules, and it's a frequent area of comment from the SEC as well. I think that's just one more element to keep in mind as you're, focusing on your KPIs. But every industry is going to have, a different set of KPIs that are more relevant to them than not.
For sure.
You said that, Sherry, because it's that is I don't see a lot of companies really appreciating setting that non-GAAP or one or two non-GAAP metrics that you know you can audit and you can consistently deliver on, but that actually if it's done right, play into, let's say you're trying to convey a new category, right? You're trying to get the investment community or even the media or others to think about your company and how you go to market differently. We did that at my last company where it was a non-GAAP metric, but we wanted to convey to the investment community and turn everyone else how we thought about bringing our members live, right? And if we could get them to think that way, it would naturally segue and lend to the storytelling of our model and how we did that and how it was different than the comps that they're going to give you. And so companies listening into this should appreciate that whether you give comps or direct people, you're going to get comps. You're going to get handed one. Some accurate, some inaccurate. So all that legwork, and you can find this out as you do that pre-IR work and the private company, meetings of how people might start to think about you and start moving them in a different direction. That's where you can inevitably land on some of these non-GAAP metrics that you would want to start conveying to the market, in concert with your wonderful accountants and legal team.
Great. Victor, what surprises do you see during the S1 review and comment process?
It's that's a good question. I think companies are surprised sometimes at really the depth and specificity of SEC comments. I mean, again, going back to, non-GAAP, very hot topic for the SEC, KPIs. We could go multiple cycles on those, and then, kind of insistence on balanced disclosures. Of course, you want to say we're the best, right? Because that's why we're here. We're doing an IPO, we're the best, but you need to balance that disclosure. And so receiving comments along the lines of, well, you're presenting revenue, but didn't you have net loss? And we need to present net loss here as well, right? So keeping that balance in mind. I think companies are often surprised that they're required to disclose sort of competitively sensitive information, or oh, do I really have to list out my competitors, and do I really I don't really want to say how we derive revenue from this particular part of the business, right? But it's all in the spirit of, right, no material misstatements or omissions, right? You need to be transparent, but it can definitely be jarring. It's the first time you're really opening up and telling the whole world about yourself. So it can be quite surprising. And then last point I would say is sometimes, but just the length of the process can be surprising if you've never done an IPO before. So, what do you mean it's going to take 30 days for them to review this document? Well, you have accountants, you have attorneys at the SEC. It's going to take a long time. It's actually multiple layers of review within the SEC. So if you haven't done it before, the length of time it takes to clear comments can be a bit surprising. So it's good to have folks who have done it before to advise you on how to do it as efficiently as possible.
You mentioned a bit about sort of the transparency and having to kind of share information that they're might not be used to. What are you guys seeing in terms of like founders balancing, the need for transparency, and then what they want to be able to share, like with the street, right? Like kind of how do they fine tune that dialogue?
Yeah.
I'll take that one first. Strictly from an in-house standpoint, I've had founders that and been at companies that were wildly transparent with employees around financials and information that we would never announce to the street, right? And so how do you balance that where you've created a cadence amongst your employees, which is paramount to the culture, and they're excited about the prospect of going public and what that might mean for them and stock options and et cetera, and educating them on what we're now going to be able to do as a company related to our full transparency on our waterfall and our metrics. And I've lived both worlds where we tried, this is many years ago, we tried to continue that into the IPO and post, and then got slapped a little bit and stopped, right? I've been at companies where we said, hey, this is what we did today, and now we're going to be all grown up in a public company, and therefore we're going to do it this way. And most people were okay with that. And then a hybrid. So, but you're going to have that conversation, and you're going to have it in concert with your advisors. And if you can get the advisors to really appreciate your culture, they're going to be pretty candid one way or the other about, hey, this is what's feasible and what's not feasible. Founders need to appreciate that. Some founders have never had exposure to the public markets, have no idea what this is going to entail. Some more seasoned, that last couple of, like a Glenn Tolman, who's had multiple IPOs and, done totally gets it. So it depends on the management team too. I'm sure Sherry and Victor have all sorts of stories on that, and it depends on that co-founder pedigree.
Yeah, absolutely. I would say that, I work a lot with technology companies. I think it's so typical of the industry to want to be transparent. And so there's some pros and cons to being transparent in the public markets. I think in a sense, it helps educate investors on, what the company sees coming. And I think that helps engage in a good dialogue and good expectations. But there is also the downside of it. If you give guidance about future results and you miss that, it can have some, negative repercussions on stock price, for example. So I think it is important for a company to think about, what fits with their culture and having some, rigor around the type of guidance and, transparency and results that they want to share that's more forward looking. But you're right. I mean, there's all sorts of different models out there. There's no one right way to do it, but I think it's really thinking about the company's culture and the confidence in what they're sharing and how much they're sharing.
And culture seems to be a common theme that comes up in all the different conversations, right? It's sort of staying true to the culture, being able to have that conversation with investors, but like not completely sharing too much either. Fantastic. And then John mentioned sort of also the importance of working closely with your advisors. So do you have best practices for staying aligned with, banks, lawyers, all the different advisors that you're working with during this crunch time?
Yeah. So early on, we mentioned the timing. So back to Livongo, we did that in 6 months. So from the time we decided that we were going to go public and pick banks to the time we debuted on the NASDAQ was 6 months. And so we were lockstep with Wilson, our banks. We were very aggressive, continue to be aggressive in the media, all the way up to the point where we couldn't. I can't think of a situation where you wouldn't want your advisors along for every step of the journey. You're thinking, letting them in. I think some companies view them as, okay, we need the Sherrys and the Victors, but do we? Yeah, you do, and you need them there in every meeting. And And the sooner you bring them in, the better. And I have found that as smart as we thought we were at any of the companies I was at, and we had figured it out, the moment you bring those advisors in, they actually help bolster your story in a way you didn't appreciate, because we can all live in a tunnel, right? Like if I'm in healthcare, I know healthcare and that's what I know, but you actually can bring other people in and can look at the prism differently. And I have found that to be very helpful. And you learn new things. And so the sooner you bring them in, the moment there's even a whisper of, I think we could be a public company, that's when I think you bring them in and you lean on them and your banks, who have done this many, many times, for guidance in all this. Even if you've got a bunch of execs that have done it, and there's always new things happening, and you can learn those best practices. Lean on NASDAQ. There isn't probably a week that goes by that I don't text with Dan. What's going on? Like we probably stole ideas from multiple different companies on how they activated, and I like what they did. It's the same thing on your advisors. They can bring in that knowledge from other companies that might be in a completely different industry. So don't just be compartmentalized in your own thinking, in your own genius.
Maybe I'll add to that too. I mean, obviously there's the nuts and bolts, project management, best practices, set up, regular calls, have a core team, assign duties and responsibilities. But I want to hit on one thing that John said, which is let your advisors in, because we will help you run faster if we're in the loop all the way. There's nothing that's going to slow down the process more than, oh, we had no idea that was going to happen, and now we don't have the time to help you fix it or fix it right, and that will slow everything down. So really leaning on your trusted outside advisors and finding that core team that will work well together with you, I think is key for successful execution.
Great. And then Sherry, what about last minute shifts in pricing, demand, or investor interest? How should founders think about handling those sort of last minute changes?
Yeah, it's a great question. And I think certainly something that, we've seen companies have to deal with in, real time. And definitely, to the topic of advisors, this is where your investment bankers are really going to help you understand what's causing the shifts in pricing or demand, and how can you navigate it. And so I think it is important for the management team to be very clear in their communication with investors. And I think it's important to build investor confidence. And so that communication is going to be extremely important. And I think also being flexible. You may have had a vision around what the price range would be or should be, or how much you were going to raise and who would generate or who would be interested. But that does change. And we've seen the market impact that pretty significantly. And so I think it is important to understand that there will be changing market conditions, and you've got to be able to adapt and think about, potential risks to what you're communicating, and really be prepared to answer questions that come. That roadshow time frame where you're negotiating, valuations and pricing is really key. And I think one thing I suggest to companies is that not to be overly focused on a specific price range that you want to get, because I think what we've seen history show us is that the upside potential of a well-run company is there. And so a little trade-off maybe in pricing during the IPO can be made up, over time as the company continues to evolve as a public company. So those would be some things that, I would recommend to my clients.
Awesome. Great. So then shifting gears a little bit, I guess going back to John, how do you think companies can best leverage their IPO day to set the tone with customers and investors?
Well, it's a branding moment, fundamentally, outside of a liquidity moment. Every company I've been at, we use that from a competitive standpoint to take the narrative over, right? And so it's as much about going public and gaining access to the public markets is it as much about the content and activation with your sales team, your employees, your partners. And so that's got to be just as critical in the comm strategy and in the investor relations strategy. The sell side analysts and the institutional investors are going to know about you if you've done your job leading up to that. And so it's what you do with that moment to then parlay that into momentum in the market. I do think, back to an internal comm standpoint, making your employee base understand that this is not a moment and then it's over. Like, you actually go back to work the next day, and depending on when you went public, you're gonna have earnings like in 3 weeks. So if there is a sober moment as everyone's getting on the planes in LaGuardia and Newark to go home. We go back to work today. But you do have to continue that momentum, and understand you now have 1,000 new bosses, and different priorities and different expectations. And depending on what kind of company you are, you don't just have the institutional investors, you have the retail investors, and all of them like to be communicated with them differently. And so you've had to figure that out, or you should figure that out long before you go public. And what your IR strategy is going to be moving forward, and have full buy-in from your management team on that, because it's a different world than what you're probably used to. But that branding moment is really what it is. Lean on NASDAQ in terms of best practices, because there's always new things you all are coming up with that didn't exist a year ago. I remember when you didn't even have CNBC. You would just sit in the little stool, right, at the bottom there. Now it's all, so every year there's a new, or months, there's a new thing you can do to reach an audience that you couldn't before. So take advantage of all of that, and let your teams in and your employees in as much as you can. But then you're back to work the next day. Everyone gets a T-shirt, and then we go back to work.
I mean, we often see, kind of comprehensive comms plan that John has alluded to, right? And sometimes you'll bring in, many times actually, an external PR advisor to really help you capitalize on that branding moment too, to get the push in all aspects of your business. And it's such a great time because everybody's been working towards the same goal, and then you're finally there. And we find that it's a great moment for the business in general. You're not just public, but lots of benefits coming out of there.
Great. Well, I've got a couple more questions.
It's somewhat anticlimactic because in the case of like your legal team, you've gotten thousands of emails from them for months, and then suddenly you don't get as many emails, and you kind of miss them. Like, where's my email from Victor at 2 a.m, right?
Fantastic. Yes, I would say we have a couple more set questions for the panel before we open to Q&A. So one just for everyone is, what's one thing you wish every founder knew before they started this final stretch to the IPO?
Well, I think it's important for founders to understand what this transition is going to entail. It is definitely a different world for many people, and sometimes they don't expect the changes, right? So there's increased regulatory scrutiny, there's increased requirements to comply with, right? So it's a very different environment. Communications, will be different. Thinking about the future and being really thoughtful in your forecasting and planning, I think takes on a whole new level of importance. And all of that while still keeping an eye on the business and staying focused on the strategic priorities and achieving the growth, right? Often an IPO is a growth story, and you certainly don't want to take your eye off the ball. And so I think the most important thing is founders understanding what that transition is going to entail and preparing for it early. Because the more you can practice something, I think the better you get at it.
I mean, it sounds a bit cliche, but the IPO is really the beginning of something else. You know, we all look at it as, oh, here's this goal, but you know, and John touched on this too. You go back to work the next day and it's just the beginning, and it's going to look a whole lot different. And unless you've been there before, it can be hard to understand. But again, lean on your advisors, have those educational sessions. Here's what to expect and what to keep in mind and how to stay out of trouble as much as possible.
I think the sooner you can start acting like a public company as a private company, the better. It's like going to the gym, right? The first 2 weeks, it's tough, you're sore, but then you feel good. Like getting in that cadence of when the investor conferences, the way you communicate. You know, every company I've been at that's done this, you know, we start having mock earnings in a year. Again, unless it's Glen Tolman and Livongo, but a year or more before you go out, and you get that right. And you have your screw ups, and you say again, the accounting team and everybody kind of starts to get in a rhythm. If you've done all that, you'll feel a lot more secure, and it won't feel like the wave is hitting you. And you know you've learned how to dive into the wave as opposed to just getting blown over by it.
No, I think that's super important, because the last thing you want to do is come out and miss your first quarter.
No,
Right.
don't
So
do that.
amazing. So now just think about listing day itself. Are there any don't miss moments or rituals that companies should take time to enjoy on that day?
You want me to go? Yeah, I think you should look around. Like it's a whirlwind. You're with your team. It's emotional. It's emotional for families. Because they're just, you know, if you're committed to an IPO, and you know, my wife has been with me on, they're in that with you too. And so take a moment to thank everyone, and it's just as important to them as it is you. And take a breath. Because it is pretty cool, even if you get to just do it once. And lean again, like whether it's NASDAQ, you know, if you don't know something, ask them. They're more than willing to help. But make sure you thank everybody too, because the amount of people hours that have gone into something like this it's hard to even calculate.
Yeah, absolutely. And I would say, like, celebrate the moment, right? It has been a lot of work to get to that point, and really take it in, take a breath, and really enjoy the experience, because not everybody gets to go through it. Some people may get the opportunity to do it more than once, but it's not guaranteed. And I think just celebrate it, because as you've heard from, you know, Victor and John, it's the beginning of the journey. And so the work doesn't end, but it is important to celebrate along the way. So that would be my recommendation, of don't miss that moment to really enjoy and celebrate.
Anything to add, Victor?
Get some pictures.
Because
Yeah, don't miss your photo op opportunities, right? No, but really, I mean, just to echo what was said, it's a privileged position. Not everybody gets to go public. You're in a very select group of high achieving companies when you do ring the bell, and so let that sink in and enjoy the moment. I guess is what I would say there.
Fantastic. Great. And then before we transfer over to Q&A, of all the years that you guys have been doing what you're doing, what is the sort of key takeaway from the different transactions that you've done that you'd want the audience to take away today?
Well, I think a lot of...
Okay, you go, Shane.
Oh, sorry. I think a couple of things that you've heard here that I would really just recap is I think the importance of starting early. It can be a lot of work, and I think it's easier to do it in a thoughtful manner if you take the time versus trying to rush. Don't go it alone, right? We said arm yourself with advisors who've done this before and can be helpful in the process, and really stay focused on, making sure the business is ready. So I think, those are all things that we touched on throughout the discussion, but if I had to sum it up, those would be my 3 key points.
Yeah, and to add
I
to
would
that,
say appreciate the
Okay.
importance of PR, right? And why I say this is this. So if you start early enough and you get enough reporters or even the sell side analysts on the IR side, and they're really bought into your story, as human beings, when you have a tough day, and you will have a tough day as a public company, probably a few, wanting as many people that are cheering you on, even emotionally or mentally, makes life a lot easier. And that takes a lot of commitment, hundreds and hundreds of meetings and media interviews and investor meetings, so that they know you're going to have a rough day. There's going to be a rough quarter. Things are going to happen. And the more people you can get behind the success of XYZ company, the better.
and really take the time to understand your business and learn your business. You may have been growing at a super rapid clip, but dig into the whys, the drivers, so that you can both articulate that story and craft that story, but also, focus on building a model that is going to help you not miss your quarters and like really, really understand your business. Spend the time there. Is hugely important, and when that is done right, the IPO is executed much better, I think.
Great. Well, thank you all so very much. It's been a great discussion. I think Colin's going to come on now to take Q&A from the audience.
Amazing. Well, thank you, Mariah, for leading such a great conversation. Victor, Sherry, John, thank you for sharing your insights and lessons learned. For our attendees, we're going to be taking live Q&A, so drop those into the Q&A box and we'll try our best to get to them all. Mariah, you did such a good job at moderating, but I'm going to call on you as a subject matter expert here on this first question we got. So how does NASDAQ support companies after the IPO to help them maintain visibility and investor engagement?
Ooh, great question. So there's a couple different ways. So if we look at the IR component first, NASDAQ owns and operates its own IR franchise. So we have a number of investor relation tools that our listed companies have access to. That ranges from, a database so they can pull up information on investors and analysts, look at their profiles, understand, what companies they're investing in. They can use that platform to manage their roadshows, their meetings, and track all their communication. So that really becomes their sort of day-to-day tool for their IR program. And then stock surveillance is probably the other most popular one, where we have analysts that are tracking the movements, who's buying, selling in a company's stock, and providing insights into what they're seeing, the trends. And then again, that just helps the company sort of think about where they want to prioritize their time, what investors they should be focusing on, where there's potential risk in their current shareholder base. And it's really an extension of the IR team. So that is probably the key way we support from the investor relations side of things. And then from a marketing visibility, we partner with our listed companies on a variety of different ways. I'm sure everyone's familiar with the NASDAQ Tower in Times Square. So that's probably, one of those iconic moments where we will help our listed companies promote milestones. They'll come to market site to celebrate, anniversaries of being listed, or, new product launches. And then we have, social team, PR team, an events team. So just depending on what is priority for our listed companies, we find ways to support them on those.
So thank you, Mariah. Victor, Sherry, and John, you may have something to chime in about this, but There's a question here from Brooke. I'm working in pharmaceuticals, which is capital intensive. Yes, it is. Do we have to have revenue before going public? My cap table's clean, but we need funding to get the FDA approvals. Victor, maybe I'll start with you and share roll over to you, and then John, if you have anything else too.
Yeah, sure. What do you typically see?
So definitely I've seen, in the healthcare life science space, companies going public that don't have revenue. And usually it's when you're in clinical trials and there's, an event that's coming, right? That's going to be interesting to investors, but you need funding to get there. So that's probably the most common scenario of pre-revenue companies going public. It's very specific to, I would say, mostly the healthcare life science industry, but definitely feasible. But I think the key thing is, what is that event that you have visibility into, right? You have to have a certain indication around clinical trials and, an idea of success that's going to generate interest for investors.
Yeah, and I agree with all of that. And clearly biotech investors in that space invest on a different profile, right? They're not investing based on that kind of projected growth, but it's just a different investor lens that they're taking to you. So certainly we see pre-revenue as well.
Yeah, I can't speak. I've always had revenue. I like revenue, but I think in the life sciences, biotech, sure, which is a different animal.
Great comment. Another question here from an anonymous attendee, and this is just open it up to whoever has experience or can speak to it. Is SPAC dying? If not, what's the difference between SPAC and IPO in a transitional path from a company perspective? And we heard a little bit earlier that there have been SPACs this year in our market update. So any comments there?
Yeah, I can start. So there definitely are still SPACs out there. There's actually been an uptick in 25 in funds raised by SPACs and out there looking for transactions. Not back to what we were seeing in 20 and 21, but I think there's always a market for it. It just sort of ebbs and flows over time, but we've definitely seen an uptick. And I'd say the difference between an IPO and a SPAC transaction for the operating company, so that's the target of the SPAC, is not very different in terms of you're going public just through a different mechanism, and all the things you need to do in an IPO scenario to get ready are the things you need to do to get ready for a SPAC transaction, because as soon as the merger completes, you're a public company and you have to comply with all the requirements. So, I think some of the differences are you have more certainty into the economics because it's being negotiated up front. You often get expertise from, the SPAC management team, which can be very helpful. And there's just, a little bit more, in most cases, certainty around, the funding. You're not worrying about, an IPO price in a roadshow, for example. You're negotiating all that up front. But those are some of the things that I would say. But from my perspective, there's not very much that's different in terms of getting ready to be public, whether you're doing a SPAC merger or an IPO. And Victor, you probably have some things to add as well.
Yeah, they're not dead, but we're not in SPAC mania 2021. Thankfully, one might say. And I think there was, many sort of misconceptions back then. And the reason we had so many, right? Like, oh, there's more leeway in disclosure, or it's a faster process than a regular way IPO. And many times that didn't prove out. And I think generally speaking, ended up with a lot of public companies who weren't ready to go public because they chose that path. I think we're past that and seeing fewer de-SPAC transactions now, but certainly high quality companies that are doing it. So the process isn't dead; it's still there. We'll see when the kind of regular IPO window opens back up what that'll do to de-SPACs as well. It'll be interesting to see.
John, question here that I think you might be able to tackle because you said you've worked with Victor and his team at Wilson Sonsini. Do you recommend using the corporate law firm's equity admin function?
Yes. Yes, very
Can you
much.
expand on
Um,
why?
yeah, you need a firm that essentially understands the IPO process. Depending on your company where you're at, they've probably been with you if you've done some pre-IPO M&A work, or if you have M&A work that you're planning on doing pretty close after, which is pretty common. And they really need to understand your business. So it's typically a larger firm that has a global reach, or certainly a very large footprint. In the case of Wilson, all right, if you think about the 1 calendar year at Livongo, they did our IPO, they did our secondary, they did our offering, and then 1 year later did an $18.5 billion merger. You can't do that without not just a corporate law firm, but a firm that understands the litany of different challenges that comes up in doing all those different components of the growth of the company. That just happens to be kind of a use case of 1 year and very unusual, but they truly are an extension of your legal team, your IR team, your PR team, your accounting team. I mean, they are essentially part of your company in a lot of respects. Thank you, Victor.
Yes. Definitely always I'm open to paying people who know more about me. Know more than things. Um, Mariah, um, this one came in. Can you share a memorable IPO moment, either something that either went incredibly right or hilariously wrong?
Um, that's a good one. I would say it's a couple of my favorite IPOs I worked on. Instacart was in 2023, right? So they're a San Francisco based. So I work with companies mainly headquartered on the West Coast. So most of my experience are West Coast companies. But they really took the employee experience to another level. They just branded everything around the IPO day. They just brought all of their local San Francisco employees together, but then did local celebrations at each of their offices around the world with very similar things so that everyone could feel like they were part of the same moment. And I just think the kind of the enthusiasm and the culture that you felt, the excitement of the day was just amazing. So that was, I think, one of the more fun ones that I worked on. Another really cool one was Allbirds, and we all got to wear new pair of Allbirds at the bell so that we were all matching. So I still have my pair at home. So that was another fun one that I was on.
Oh, and I'll tell you, NASDAQ has a pretty sweet swag game going on. So for any of the companies listing, they have an amazing capability on what they're able to do and how they activate. It's pretty awesome.
Yeah, that's great. To double click on that, John, there's a question here that said, what are the intangibles that make a bell ringing ceremony memorable? But what are also the tangibles that you
Yeah.
experience?
I think that the things that make it memorable is we had, I think, like 175 people on site at NASDAQ for my last one, which is a lot, right? Because you wanted as many employees and early investors and everybody that was involved, but the ability to bring in all the different locations around the country. By the way, a lot of companies they have a big appetite for that when they start the process and they say, "Oh, we want to do this," and then they realize the scope of that, and they kind of back off. Um, we didn't at Livongo. We went full bore. I think, as the team listening probably knows. And so, yeah, you've got folks on site and doing interviews and TV and SAT hookups and activating that for your employees. And so they are about as in New York Times Square as possible. A lot of work, certainly adds a massive amount of layers of complexity. Earlier on in the panel, we talked about you're trapped in a little room waiting for a number from the legal team, but there's a lot of things going on. But boy, if looking back on it, to think that we wouldn't have done that and have Chicago, Mountain View, and that made it so memorable. outside of the fact that I didn't get a t-shirt because no one put one aside for me. Outside of that, it was great.
And you're not good
Oh,
about that at all, right?
Yeah. I'm still waiting on the t-shirt. Yeah.
I guess I'm sure we can figure out how to get you one. Uh, uh, that's great though. Victor and Sherry, maybe I'll start with you here. What's one thing companies always underestimate in the final weeks before going public?
I think, underestimating surprises. There will always be, I think, something that comes up in all the transactions that I've worked on. You do your best to anticipate everything and be as prepared as you can be, but there can inevitably be a surprise. And so I think just having built capacity for that, so having planned well, having rested, having eaten well, having exercised, right? It's a long process that takes a lot of energy. So I think all of that is important. But yeah, there will be some surprises, but you can, you got to be flexible and you got to adjust to it. And I think you can prepare for that as well.
Victor.
Yeah,
I'm glad you said that, Shay, by the way. I think that's on taking care of yourself physically and mentally. I don't think a lot of people think about that with the thousand things going on. Like, it does no one any good if you crash that, especially that final week when it's really starting to become real.
Yeah.
We've heard stories of people leaving to get on a plane after the bell and they just come down with the flu, right? Because it's like all that adrenaline has gotten you through that period, and suddenly you're like, I'm
That's right.
done, and your body just crashes. So yeah, definitely.
Victor, you're going to say something?
Really echoing Cher's points. I mean, there's just so many things that can happen the day before you launch your roadshow or in the middle of the roadshow, and preparing as much as possible so that you can be as flexible as possible and pivot quickly and make quick decisions. It's easy to underestimate the importance of that, but hugely important.
We got a inquiry from an international founder here. So are there any general broad guidelines on what you would tell a founder looking to list in the US who's not based here?
Well, I think one thing I would highlight is our regulatory environment in the US is probably the most stringent of any jurisdiction around the world. So I think being prepared for that is important. But there are benefits that foreign private issuers can take advantage of in the US, which helps alleviate that to a certain extent. So, the benefits of the US market and the investor base that affords a company, even from outside the US, I think is huge. And so it's just going in eyes wide open, right? Understanding what the rigor is going to be, and taking advantage of the accommodations that a company can.
Victor, from a legal perspective?
Yeah, I would say that too, right? And so, and many times though, what we find is even though you can take advantage of a number of exemptions, and sometimes there's an expectation from US investors that you try to look as much as possible as a US company anyway. So you end up complying and essentially, operating as if you were a US domestic company. But yeah, I mean, again, it's just for anybody going public, there's a lot of compliance that goes into it, but certainly a lot of benefits that come with it as well.
Amazing. Question to the panel, just a curiosity, because you were talking about how virtual roadshows shortens the time. Question here, will the 2-week roadshow ever come back?
My take is probably not, but you're going to see exceptions, right? And so there may be instances where, well, one instance would be with your first week is not going as well, and you need to pivot and you need to meet with more investors to build a book, right? That could be one example. But you could also be in a more unique position where you really need to speak to more investors to get your message out there, to really build a book that you're looking for. And it's going to take more than the 4 or 5 days that we're seeing more often now. But is it going to come back to, more broadly? I don't think so, if I had to predict.
I'd say it's kind of a trade-off, right? Because you're doing shorter road shows, but you're doing a lot more meetings ahead of that, right? So before you could do 2 weeks of meetings in the road show, but in the lead up, sometimes you're meeting investors for the first time, right? So now you're doing so much more ahead of it that you're able to shorten it, but you're spending probably more time meeting with investors just at an earlier stage.
And you're also meeting with more investors per day when you're just doing these 30-minute, 1-hour meetings back to back, as opposed to, now we have to, spend the time traveling to the next destination. So.
Well, we're almost out of time. One final question to this group, round robin format. So I'd like to hear your answer to this from everyone. What would you say to a founder, given this market, a founder or CFO listening today, who's 6 to 12 months out from looking at listing?
I would say, not knowing in that scenario, where they're at from a funding standpoint. But let's make the assumption they're pretty well-heeled.
And they've covered the bases, the yellow top.
Yeah. Continue to get ready. If that's something you think might be on your radar, because you don't know. I've been at companies where you get ready and you don't know, and then the phone call comes, you're going. So be ready, but also make sure you entertain if funding is an issue that you're running that parallel process as well. But don't stop. So people make that mistake where they stop. It's really hard, like anything in life, to rekindle that energy. The NASDAQ team would know that too, right? With a lot of the companies in your pipeline.
Yeah, I was gonna say, it's just being prepared generally. A lot of things we already talked about, right? Just making sure you have the right processes in place, that you're doing mock earnings, so that when the window does open up, you are ready to go. And if it gets delayed a little bit longer, you kind of have to maintain it, but you don't want to have to start from scratch again, so.
Absolutely. I think 6 to 12 months isn't really that long, and there can be a lot of things that need to be done. So take advantage of the time while the market is choppy and people are sort of watching and waiting and seeing, because you never know, fingers crossed, you never know when things are going to open up again, and you do want to be ready. And so now's the time to take advantage of the time that you have and get everything in order so that when things open up, you're ready to go. You want to be one of the first ones.
Yeah, and I just, as a very practical tip, I would ask your outside counsel, if you have one, who you'd work with as your IPO counsel, to put together 2 timelines for you, right? Like, so what would it look like if I'm going public in 6 months? What would it look like in 12 months? And not just your lawyer, Sherry and her team as well. What do I need to do if we're actually doing this in 6 months? How would that look different if we're doing it in 12 months? And just get a very clear set of slides or something to start building that understanding now, and then you can make a decision based on market conditions. But it's never too early to at least get the understanding of what would be required and when.
I think that's a common theme we're seeing all day long, is get prepared before things get busy. Well, Mariah, Sherry, John, Victor, thank you all so much for joining us today. It's been a pleasure to learn from your firsthand experiences, and really appreciate the time.
Thank you very much for having us.
All right, awesome. Well, we'll keep in touch and see how everything progresses. So before we transition into our final session of the day, achieving success as a new public company, please take this time to take a quick break, and we will return shortly. See you in a little bit, everyone. All right, all right. Welcome back. And now for our final panel of the day, Achieving Success as a New Public Company. We've covered a ton about everything that you need to do to prepare, and then actually from the roadshow to the bell. But now up next is what happens after that. So without any further delay, please join me in giving a warm welcome to our next panel of experts. First off, our moderator was going to be Tara Ryan, the CMO at Savient, but she had a life moment happen. So I'm going to be taking over and doing my best as your moderator today. But joining me as our panelists, we've got Prasad Kadambi, who's a partner at KPMG. We have Shannon DeLahey, who's a partner at Wilson Sonsini, and Kaylee Krafa, head of board advisory at NASDAQ. Welcome, everyone.
Great to be with you.
Alrighty. Well, let's before we kick off into our planned discussion, maybe just a quick round of introductions, who you are, what you do, and where you plug into this part of the process. Shannon, maybe I'll start with you, Kaylee, and then we'll have Prasad round us out.
Sure. Hi, everyone. It's nice to be here with you all today. I'm a partner in Wilson Sonsini's Palo Alto office in the corporate practice, and I split my practice about 50-50 IPOs and then public company representation post-IPO for the companies that I help take public. So kind of that coming right out of an IPO, post 3 to 5 years is my sweet spot, and looking forward to discussing some things that you might be thinking about as you head into your own IPOs.
You, Shannon, happy to have you. Kaylee.
So I am the head of NASDAQ's board advisory practice for the Americas and Asia Pacific regions, and I get the privilege of working with a lot of public company boards situated in jurisdictions around the world, but those that are at various stages in their life cycle, some that have been public for many decades and some that are newly public or on their path to going public, and get to really help them understand what do effective boards look like, think like, act like, and do based on what the company needs and where it is in its growth trajectory. I came to this by way of a traditional legal background, so I've served in-house and in private practice roles, advising corporations, and then also have served on the board of some private corporations as well, and like to bring that lens of thinking as a director as I'm working with clients and their CEOs and founders to think about what the company needs.
Love that. Prasad.
Yeah, good afternoon, everyone. I'm Prasad Kadambi, with partner with KPMG. Been with KPMG for a long time, mainly serve public company audits. My past life, I also spent some time as a chief operating officer of a public software company up in Portland. Happy to be here.
All right, happy to have you. Okay, well, to kick us off, this is going to be a roundtable to the panel question. What's the biggest mind shift leaders need to make after ringing the bell? Kaylee, maybe I'll start with you.
I'll start with maybe 3 separate ones here. First, I think from a mindset perspective, there's a requirement of both the board and the CEO and other executive leaders where they really need to understand how to develop the discipline and the rigor that's required for a public company to meet the requirements of its investors and other regulators. But I think that there's an ability for these companies to be able to continue to harness some of the agility and innovation that may be in the DNA of its company as it's come through some phases of significant growth. And so I think finding that balance between discipline and rigor and innovation and agility is one that can often present challenge, but really great opportunity as the board and CEO are able to align on how to do that effectively. And then the other 2 areas that are related to that is one around the shifting dynamic between the board and the CEO based on the board's fiduciary duties to long-term shareholder value, which changes the dynamic of what a company may have experienced and the CEO may have experienced in a closer partnership with the board whenever they were private, particularly with either VC or PE backing. And because that really ties to investor expectations and regulator expectations around accountability for performance and risk mitigation that is primary responsibility of the board. And then the third piece that I would add here that's a shifting mindset is scrutiny on the board itself. Private company boards do not have the level of scrutiny that public company boards do, and that's on the board as a whole, as I previously mentioned, as well as potential scrutiny on individual directors, which we can get to later in our discussion.
Love that, Kaylee. Shannon.
So after you ring the bell, you now have a real-time metric by which to gauge your company, which is a stock price. So I think that it's pretty easy for founders and executives and the entire company and even their outside attorneys to be obsessively checking stock price for their companies. And I guess the mind shift switch there, I think, is really trying not to be phased by all the noise in the market, of which there is a lot, and just staying laser focused on running the great company that allowed you to go public in the first place. Stock price is up, everyone's happy. If the stock price is down, everyone, including your entire employee base that might have a lot of significant wealth tied up in employee compensation, will be not so happy. And I hope that all of your companies are just up and to the right forever and ever, but there will inevitably be disappointing quarters, missed consensus and all kinds of things of that nature. And so sort of just expecting that you will have some hit some speed bumps along the way and being prepared for that and not letting it bum you out.
Great advice, Shannon. Prasad.
Yeah, I would say embrace transparency and accountability. I think once you're a public company now, you have more higher transparency and accountability to public stockholders, regulators as well, and be focused on the long-term strategy vision as well. You could get distracted significantly, like as Shannon said, on short-term fluctuations and market blips. And being able to clearly articulate the vision, strategy, and the performance of the company would be important. So communication would be key on a routine cadence as well. I think those are the three things I would highlight.
Great advice, Prasad. All right, Shannon, from your perspective, what changes immediately once you're public and what takes longer to feel?
I think immediately after going public, you have to start thinking about all of your reports right away. I mean, there are some companies that go public and almost immediately thereafter need to get a 10Q on file. In some ways, it's sort of easier because you've just drafted your S1. But kind of that continuous earnings cycle of filing your K and then immediately flipping to your Q and all of that just takes a lot of time. So I would say just making sure that your legal team and finance team is built out to be able to support the level of intense work that will come out of your post-IPO phase on the reporting side. And then the longer effects to feel, I think that companies over time gradually start restricting the information sharing more and more and more. That's sort of a big thing that we always think about, especially as companies are putting into place insider trading policies and the like, after they're public. A lot of companies before they're public have, big, huge meetings and town halls discussing results and all of that. And that's still totally fine to do. But usually we encourage companies to do that, at the same time that the rest of the investing public is hearing the same information. So there sort of becomes a little bit of a, people in the know culture at the company versus those not in the know. And I think that's a bigger cultural shift that, companies go through as they mature into big public companies.
Great. Prasad, speaking of reporting that Shannon was talking about, what are some of the most important critical internal controls a newly public needs to implement?
Yeah, I would say some of the critical internal controls the companies need to have would be the financial reporting process. That's what the SOX is for. So that'll cover like your revenue process, the quote to cash process, the procurement process, like anything that touches the financial reporting process would be in scope. So making sure those are tight and company's been through a dry run on making sure those proper review and approval policies are there and proper review and authorization of transactions happen. So I think that would be critical. And also to making sure the IT systems and compliance is in shape. So it's not just the financial reporting process, but also all the IT systems that comes along with it, making sure there are proper checks and balances on the IT systems as well, like general ID controls and application controls. And lastly, I would say that any entity level controls are also in place. Like, for example, code of conduct, and Shannon talked about insider trading policy. Those are also in place to make sure those entity level controls are in place as well.
Good advice. Kaylee, speaking of tools, what tools help boards operate effectively in a public company environment?
So I often recommend that a new public company board needs to have a diverse and agile toolkit that enables it to meet the varied circumstances that the company and the board will be facing. I think really importantly, having directors who understand public company corporate governance and public company board practices can really help the board and the CEO come to alignment on really critical matters such as the separation of the CEO and the chair, or do you have a combined chair with a lead independent director? How do we structure our committees if we want something beyond our statutory committees? What are going to be our reporting protocols beyond those that would be prescriptive and tie back to the internal controls that Prasad mentioned? What are things where the board must be informed or approved versus areas where the board may want to have norms or expectations with the CEO around areas that are really important to the company as a whole and to the board's ability to fulfill its responsibilities that may not hit the prescriptive threshold, but there may want to have reporting protocols to maintain alignment between the board and CEO and the board's understanding of the company's performance and risk. Then having, on the more technical side of tools, having resources like NASDAQ Board Vantage, where they have their portal to be able to securely access company information and communicate with directors and executives to be able to provide information that Shannon mentioned that's going to have to go into their required filings, whether it's directors disclosing new related parties, disclosing new roles that they've taken on that may create a concern around conflicts. And so having the tools to do that is important. And then Myra earlier mentioned access to tools such as through IR services. NASDAQ's relationship managers are really great at providing CEOs and boards with information on what is it that we need to know, so we are ensuring that our company is operating in alignment with the expectation of our investors and all of our other stakeholders, which depending on the company's business and where it operates, they may have climate reporting requirements where companies may be looking for tools like Metrio to ensure they're meeting those reporting requirements. And then more broadly, I would say just having a list of advisors and peoples within the board and CEO's network. So whether it's reaching out to Shannon as outside counsel to understand, we need to understand what's the new regulatory requirement here. What do we need to know as a board? What does the executive team need to know? And then how do we build that into the company's processes and practices? Ensuring they have a good relationship with their independent auditor. I think that that's critical and something that very adept audit committee chairs will understand the importance of that relationship and then the process for ascertaining independence on an annual basis. And then looking for specialty consultants. A lot of boards are bringing in cyber experts to help them understand the cybersecurity reporting requirements under the SEC's regulations. And so I think having a really diverse toolkit with the list of all of the resources available and then those that are mission critical helps the board ensure that it has the expertise in the boardroom, in the C-suite, and then surrounding them to be able to operate effectively.
Awesome. Thanks, Kaylee. Speaking of leaning on Shannon, I got this next question for you that's related to the board. So what changes are required at the board level post-IPO, and how should founders prepare?
Sure. So post-IPO, the stock exchanges have a variety of requirements and the SEC for independent directors. I won't bore you with all the details, but suffice it to say that you'll need some independent directors on your board and independent directors to form your committees. And so, pre-IPO, we'll go through the analysis to figure out who on your board currently is independent and if you need to add any independent directors. Add that together with just, VC directors that might be rolling off over time or will be expected to roll off over time. It usually corresponds to their ownership level. So, it might be, post-IPO by 2 or 3 years or longer. Sometimes you have directors on your board that were a good fit as a private company, but for whatever reason, you don't think they will be a good fit going forward, or they don't want the responsibility and the scrutiny, as Kaylee mentioned, of being on a public company board. And so you might have folks that voluntarily want to roll off. And so I would say in the pre-year leading up to the IPO, you should really be looking for those new public company directors that you'll be adding, and getting the right mix of individuals it can be challenging because it's a whole new dynamic in your boardroom. And so I don't know that I have any special tips for success there, other than to try to have your board spend as much time as possible with, the potential candidates, so that everyone really feels comfortable about the new people that will be joining your board. So that post-IPO, you have, a good working relationship and a well-functioning board.
Great advice. Prasad, how can CFOs and finance teams prepare for quarterly earnings and SOX compliance?
Yeah, so I think having a tight financial close process would be key, because sets the tone on when I can start my earnings prep. So I would say between 3 to 5 days to have your financial close be done. Once your financial close is done, then you can start the earnings prep. And also your monthly close. I would say that your monthly close is pretty important. That gives you good information on how the quarter is progressing along. So I would say that as well would be key. And as far as earnings prep, like in my operating role as a chief accounting officer, like what I've seen that works pretty well would be that at least have like 3 group earnings prep sessions, going through the earnings material, potential Q&A. That's where like you have the CEO, the CFO, the CAO, the IR person, and also you may be a chief operating officer who's involved in a lot of people. There's an army is involved in earnings prep. So having the group session would be important, and so that you're prepared to any anticipating questions you might get, being prepared for those. So that's what I would say. From a SOX compliance, I would say having a detailed checklist to making sure that people are performing their controls, close checklist would be critical as well.
Great advice. Kaylee, back to you. How do digital platforms support all of this transparency everyone's talking about, collaboration amongst board members and stakeholders, and investor engagement?
I think it's critical for boards and companies that are operating at the speed that the market demands. When I think about the work that I do often with particularly companies that they're newly public and the board is in that, first maybe 3 to 5 years, I see a maturation that occurs at differing rates around how the board really understands the benefit that it can provide to ensuring that the company is telling its story and articulating value to its shareholders and relevance to its customers, its employees, its partners in a way that is productive and benefits the company in the short and the long term. And I think boards that understand now, how is it that we have access to insights that tell us what are our investors thinking? Do we have access to information coming from employee systems that are pulling data on employee engagement, on our competitiveness in the talent landscape? So I think that boards and companies that really think about how is it that we have these tools that are integrated and then pull information to the right level, whether it's for a functional lead in the executive team, whether it's information that they will be reporting up to the board, or that the board and CEO, CFO, IR officer are thinking about reporting out to investors, having the information and then ensuring the message is tailored for that group or even subgroups within various stakeholder groups is really critical. Because if not, we see stories of what happens if information is incomplete, ambiguous, conflicting, or otherwise unclear. People are going to fill in the blanks. And as a public company board, particularly in that critical early phase, you don't want people filling in the blanks when you really have the ability to drive the narrative around how this company was built, what it stands for, its corporate purpose, its values, and how that translates into its ability to compete in the short and long term, I think is critically important. And so identifying what those tools are, those that are already being utilized internally, and then how they can be integrated to provide that comprehensive view that scales up and scales down as necessary, drives better organizational alignment and helps avoid some of the missteps that we've all heard the stories of what happens if the wrong information gets out or there's an absence of information.
I love that. Shannon, question for you. How can companies stay ahead of SEC compliance and disclosure obligations?
Hey, your guess is as good as mine, Colin, because I don't know what the SEC is going to do at any given day. So, I mean, it is true. I mean, there are, been a lot of new rules and they've been challenged and, they've been revoked or, so I don't know that you really can stay on top of things too much, but I will say that, for the proposed rules that are out there, usually there is a long ramp. So, working with your outside counsel and inside counsel that might be experts in this area to just understand what the new rules are proposing to do and kind of thinking about it. And then usually, especially on new disclosure obligations, there are typically companies that have a cycle that's a little bit off from yours. So we always like to go through and figure out, who might be the early disclosures in this area and do some benchmarking. I think that always helps inform what we recommend companies do going forward. But again, it's kind of a wild card in terms of how to stay on top of things when you don't know what you're trying to stay on top of.
Yeah, how much would you worry, just to double click on that, how much would you worry about a potential new disclosure on the horizon? Do you start prepping immediately or just think about like scenario planning around what happens if?
Yeah, probably the latter. It's always good. I mean, climate disclosure was kind of one of a good one to think about because when folks were thinking that they might need to do the scope 3 reporting, I mean, this is very technical. That was something that was going to require a huge amount of time and effort from different people at the company. And so there was a lot of talk of, I think you sort of just look at the long poles in the tent and you think, if we needed to disclose this, what information would we need to gather? How would we staff it? And if you have something like that coming down the pike that you think might be really, major, and you need to staff up accordingly, it's a little bit hard to make that. I don't know what I would do if I were a founder in that position because you don't want to build out an entire team only to have the climate rules, withdrawn. So I think that a lot of people were sort of taking a wait and see approach or kind of just like dipping a toe in to understand it, but not moving full steam ahead. But I mean, maybe that's a bad example because there are climate regulations in other parts of the world, in Europe, et cetera. So there's still some amount of compliance that companies needed to do. But yeah, I don't know. Usually on new rules, people don't rush out to immediately have all the people in place and all of the draft disclosures, but they at least know a little bit to start thinking about what they might do.
Yeah, being aware of, that's good.
If I can add to that, Colin,
go for it. Yeah,
I think Shannon's perspective there, particularly with changing regulations and speculative policies that we may see, I think it's important, as Shannon indicated, for the CEO, founder, a broad group of leaders across the management team in collaboration with the board and outside counsel and other advisors to philosophically align on, do we want to be the pioneer or the leader, particularly on something of this matter, or do we want to be a follower or, in a very critical instance, be deemed as being a laggard in disclosure? And so I think some of that philosophical alignment can be very helpful in just sitting down, having a bit of a war room situation, saying, this is what we know, this is what we don't know. Now, where's our comfort level as a board and as a management team and with the advice of outside counsel so we come to the right position that won't put the company at either the risk of utilizing resources in an imprudent manner that doesn't actually come to fruition, or putting itself out in a place where it's disclosed information that may not be advantageous or required.
That's a great addition to Shannon's points. Prasad, question for you around what are some of the early missteps to avoid when transitioning to public reporting?
Yeah, I would say inadequate preparation would be something to think about. It's like being prepared, the earlier the better. Thinking about financial systems that could support scalable, growing organization. So having the right financial systems for reporting and everything would be important. I remember ServiceNow, for when they were 100 million in revenue, they implemented SAP. That was too early. Some people might say it's too early to implement, but they were seeing the growth potential for the company. So those kind of things to think about. What are the right systems that needs to be in place? And do not underestimate the regulatory requirements, right? Like as Shannon mentioned, and you need to make sure that you have the right team in place for the regulatory requirements to be prepared for it. once you become public reporting. So those are, I would say, to avoid, and have a good investor relation department, build on it much ahead of going public. So, and corporate communications department. So those would be critical, I would say, to avoid early missteps to avoid.
Great advice. Kaylee, you talked a bit about this a little bit, but I just want to double down on it. What role does NASDAQ play, and you, in helping new public boards stay organized and informed?
So I'll just bypass some of the comments I provided earlier around the broad array of services and solutions that NASDAQ offers to corporations at various stages, because we really do have an ecosystem that enables a company to come in and say, we need this, can you help us recommend what else are we not thinking about? Then we help resource companies with what we think is necessary from a service and solution perspective. But more broadly, in my practice specifically, in working with public company boards, I'm often helping them think through the critical questions that they need to be asking after they've been given the advice from Shannon or their outside counsel on meeting the prescriptive requirements around corporate governance from an independence perspective, from their reporting requirements. Then it gets into the more dynamic aspect of what is it that we need to know as a public company board. And then it gets in discussions around board succession planning. I do a lot of work with boards to not only help them once they've gotten their board that they came through their IPO process with, but how is it that we start to think about our philosophies on board refreshment? Do we have prescriptive requirements around age limit or tenure limits? If not, do we want to adopt those? What are the benchmarking perspectives on those? What is it that will ensure that we maintain the board composition that aligns to the company's business and its long-term strategic needs? How is it that we work with the CEO as they're moving through their windows of maturity and as a new public company CEO, particularly if they're a first-time public company CEO? That's where the board really has to understand the person and the circumstance, and that work is very dynamic. So we're often working with them to help them understand the process coming through the comp committee for executive compensation planning and then end-of-year performance reviews. On the more dynamic side, how are we providing feedback to the CEO to ensure that they are excelling in the areas where they have innate strengths, and then expanding in responsibilities that, often investor relations may be a new skill set and set of responsibilities for a public company CEO if they've never done that before. And then more broadly, looking across NASDAQ, we have a lot of access to internal experts, whether it's Phil McIntosh as our chief economist, looking at people on our listings team that both work with companies and take them through the process to go public, or then help them as they are public companies listed on NASDAQ. We provide regulatory perspectives under Ed Knight and Terry Campbell and some of our other folks sitting down in DC who are really in tune with what's going on at the SEC, and then more broadly around the world, what we're seeing in rules being promulgated in other jurisdictions. And then within another organization within NASDAQ, we have the NASDAQ Center for Board Excellence, which is our director education and peer networking organization, where we produce publications on a range of governance and business topics that are tailored for the perspective of a director or a CEO. And then we provide opportunities for directors in small and large circumstances to get together and actually be in facilitated dialogues with people who are sitting in their seats or who have sat in similar seats previously. And so I think enabling those types of exchanges of information is really a way that we take a comprehensive view of providing information on a macro level, as well as getting into more intimate circumstances where we can bring people together who are committed to helping make their companies successful, and then also to helping others do the same.
Great advice. Okay, Shannon, so speaking of governance, how do you recommend boards build strong governance cultures early on? You mentioned a little bit about this when new board members are coming into the equation, but just in general, as the new public board, we're all at the table now. Any advice there?
Sure. I like what Kaylee said earlier about sort of aligning on philosophy of where you want to be. And, maybe not every company wants to be the market leader and great governance in every single regard. And that's probably okay if you're a newly public company. So sort of deciding where you fall in the spectrum and then devoting the proper time and money to it, I think is really, how do you get good at anything? Like put time and money into it, and then you'll be good at it. So I think, for example, when boards are getting ready to go public, a lot of times, like a lot of the governance policies and things kind of fall to the wayside as teams are focused on drafting the registration statement and going through the process. But if you can really sit down with your board, 6 months in advance of going public and have your committees kind of pour over all the policies and their committee charters that outline what they're expected to do post-public and get their buy-in and have real discussion about those policies, as opposed to just, your council presenting, okay, here are 15 policies that you need in place at the time of the IPO, and the board saying, great. I think that will help educate the board members, and then making sure that either with your chair or your lead independent director, or sometimes the head of your nom-gov committee, that you're sitting down each committee and going through, okay, what is our committee expected to do on an annual basis? Having some calendars in place to make sure that the board and the committees are setting aside time for things that you can sort of lose sight of. I mean, if you're thinking about onboarding new directors, then you could have entire meetings taken up by, this candidate or that candidate, and you sort of lose sight of, hey, should we be thinking about succession planning, or should we be thinking about this or that? So making sure that on a quarterly basis, or however often the committee is meeting, just making sure that you're leaving time in your meetings. It sounds so basic, but boards are busy and they have other things on their mind. And so tackling some of those things is not always top of mind for them. And then I would say that on the money piece, what I mean by that is just having legal and finance teams that are really focused on governance. And good governance also comes from good training at the company. So again, if you have a very, very lean legal team that can barely handle just, getting your quarterly filings in place, you're not going to have a lot of time for teams to put together, amazing internal presentations to educate the company on everything that they need, insider trading and export controls and FCPA and all of those types of things. So finding the right balance for your company, but making sure that you just prioritize it and put some resources into it.
Sound advice. Prasad, what does a typical quarter look like now, these days, in the world that we all live in, from earnings prep to analyst calls?
Yeah, so I think it's a 2 to 3 weeks process from the quarter close, depending on the size of the company and what your earnings calendar looks like. And I would say that in that 2 to 3 weeks process, like I mentioned before, the closing your books on a timely and earlier, you are able to close your books more accurately. Then it gives you more time for earnings prep as well. And I would say that in that process, we have like usually an audit committee meeting, a board meeting to go through the reviews, the earnings results in the time frame. And I would say from a callback point of view, I've seen like the new trend I've seen is to have a group callbacks that is after your earnings call. Uh, like you have like say you have 30 analysts covering you, you could probably have a do a callback with your sell side analysts with 10 of them on the callbacks, and then like so you have 3 calls with 10 of them each on an each callback as well. So that's what I would say is to think about whether do you want to have an individual callback or a group callback. And earnings prep would be to be focused more on getting your books closed and having adequate time for financial analysis, guidance prep, and guidance formation and everything. So.
Awesome. And to stay in that lane for a moment, you've been in the game for a while, as you mentioned in your introduction. What's different now than from pre-COVID 10, 15 years ago?
Like I said, like I think the timelines are more shorter now. I would say from before. I think it's a little bit more focused, being more clear and crisp communication would be important, and being more transparent. I think people are more focused on business performance metrics as well. Like if you're looking at 10, 15-year time frame, it's looking at more like the other metrics, operational metrics as well. I would say that's also been the trend that has changed. So
Great. Kaylee, How should companies think about investor communication and shareholder engagement in year one?
It's an exciting first go at it. I think that there's learnings that companies, in particular their management teams and boards, can learn from other public companies. So you're not trying to create something from scratch. But one, I would think about, what roles are the various key players on the board and the management team going to play in the communications with shareholders, and it's going to vary based on the organization's investor groups, and in particular their substantial shareholders, institutional shareholders, and other groups that they may have represented within their stockholders. So determining the strategy based on the particular representation with your investor base is important to think about tailoring it appropriately, and then determining who's going to be, and I think the board has a role to play in this, who's going to be best suited from the management team. The CEO clearly has a role in communicating with shareholders on the vision, the strategy, the health of the business. The CFO similarly has a very important and defined role in that. If they have an IR officer, or if they have someone who's holding IR responsibilities but without that specific background, I think the CEO and CFO and board will really need to work together to think about what are going to be the right circumstances for someone with either the IR officer designation or IR responsibilities. How are they going to communicate and engage with the investment and analyst community? And then also helping the board prepare for expectations that investors may have for direct engagement with directors, and in particular, either the board chair or lead independent, and then certain committee chairs, your audit committee, comp, and non-gov, to be able to talk about matters of governance and board oversight of company controls and performance. I think is very important to prepare for that. And then the last piece on that point of preparedness is some companies that I've seen over the course of the past few years that went public, they may have had, especially if they went public in 2021, 2022, they had a really nice initial runway, but then they hit the reverberations that we've seen in the stock market, challenges more in broader economic conditions that have created consternation in the investor base, to where then the company becomes likely or subject to investor activism. And, the boards that I've worked with over the past few years that either have had an activist or just broadly aware of how busy the activist community is, the ones that have done it well say, we stopped and we had a session with the board and our management team and outside advisors, bringing in information on investor perceptions of what they see as the value of our company and then what they're criticizing about it. And we're really doing good listening exercises, and we're being responsive to those. And then also preparing in the event of an activist, if companies are getting down to the place of, we hope no new public company listed on NASDAQ will hit this circumstance, but for those that do hit the circumstance of having plummeting stock prices, or liquidity events that they expected to occur that don't occur in the timeline expected given market conditions, how is the board and the CEO going to be prepared for that? And I think it can be very helpful for the board to be the one who says, let me have an individual director take the view as an activist in this scenario planning exercise to say, if I was going to criticize this company, this is what I would hit on, and these are why I would do so. And so then it creates a collaborative environment to where the board and management team can be proactive in their investor communication strategy. So they're getting ahead of messaging, they're listening to their investors, and then preparing for what they hope will be circumstances that don't come to fruition. But in the event that they do, they know we can have this plan, and this plan ready to action with the people that they would need to be able to action those.
A great answer, Kaylee. I was going to double click on activist armor, but you just nailed it. So great job. Thank you.
It's something I would like to not have to touch on so much, but unfortunately,
it is a reality. It is a reality, and having everything done that you just talked about is good advice. This question's for the panel. Let's see, what's one piece of advice you give to a founder or executive team about staying grounded post-IPO? Shannon, I'll go to you, and then Prasad, and then Kaylee round us out.
Sure. I think it's easy to get, an IPO is obviously a huge event for the company, and there's a lot of momentum leading up to that event. It's sort of easy to get distracted in all of the hubbub about that. You're ringing the bell, you're on press tours. There's a lot of that. think as soon as you do that, it's just, it has to be immediately back to basics, back to the business. This is the time now that your, potential customers and partners are going to be like the most willing to engage with you. Now your company's out there, it's been publicized. So it's like the perfect time to kind of go back to the business and don't take your foot off the gas, I guess. In some ways we're telling you have to do all these things as a public company, but in other ways, it's like sort of act like you're a private company still and just focus on what you did to be so great to now be a public company. And don't lose sight of that. I think it's kind of easy to take your foot off the gas, and it's going to be a big slog to go through, like earnings cycle after earnings cycle after earnings cycle, and building the best, most sustainable business is the only way to get through all of that. And so that would be my piece of advice.
Great advice. And one of our panelists from our second panel of the day said from the roadshow to the bell, make sure you just sleep and eat and take care of yourself. I'm sure.
While on the private jet.
Yeah, right. While grinding it all out, right? So I think that's just good advice in general for us humans. Prasad, anything to add there?
Yeah, I would just say, just like you teed up, just stay grounded, like stay close to your core mission and strategic priorities. You could get distracted. So like so that's what I would say, just to be grounded and be core mission and strategic priorities, just be focused on that and not get distracted by all the fluctuations and all the noise that might come along with being a public company. So
great advice. Kaylee?
They summed it up really well. I think more broadly, and to take it to perhaps a cultural reflection, is that although it's important to recognize the achievements that have occurred to get the company to that point, you're going to be met with headwinds, you're going to be met with unexpected challenges. And so I think the more that the CEO and the board can be the people that really exhibit resilience in light of challenges and frustrations, and also cultivate a learning mindset where it's, maybe we had a misstep. What is it that we could have done that would have allowed us to achieve a greater level of operational excellence during this quarter or during this half of a year, can really be important to, taking the road in stride, and, sometimes taking some things to the chin and saying, just because we messed up doesn't mean that it's representative of the value that we bring to our shareholders, to our customers, to our partners, and others that view us as being a valuable company, particularly as a public company that often has an even larger growth map than it may have as a private company. So I think keeping that in stride and resilience and a growth mindset can go a long way in moving through the ups and downs of the first year as a public company.
Kaylee, maybe just to add to that, I like what you were saying in this vein. Sometimes maybe something isn't even a misstep, but you're measuring the business in the wrong way too. So we've seen, you spend all this time in a war room with bankers and lawyers going through key metrics, but then sometimes when you get out there and practice, you realize maybe this isn't quite capturing exactly how we see our business now, or it's just not being understood or received in the way that we intended. So we do see usually, 2-3 quarters out, companies sort of taking a step back and saying, oh, like, is this really what we want to continue to report on a quarterly basis? Is this really the right metric for us? And so just because that's what you went out and did your IPO on you shouldn't just change them on a whim, but there is flexibility there. So I guess being flexible in terms of how you tell your story on a quarterly basis is important to keep in mind.
Shannon, you actually bring a good example to mind. There's a company that I work with that there was a new market entrant in the industry a few years ago that literally was unforeseen in the landscape. No one in the industry, including the researchers behind it, could have predicted that this new product would have come in and completely disrupted the industry. And the company that I've been working with, instead of this company taking it as, this flipped the apple basket upside down and we don't know what to do, they went through a very protracted process of saying, this new product we were launching isn't going to have the competitiveness that we would have hoped that it would, given the new market entrant. So what is it that we're going to do now? How is it that we're going to think about the investment that we've already made in our R&D and the future revenue streams that could come from that product, given this change in market circumstance? And so I think, that's, either the company wasn't being measured on the same metric or circumstances changed unpredictably. And so I think, in thinking about those translatable experiences and then learning how the company can have a core and a history that drives it towards its future, but that doesn't mean that it's stagnant and limited in its purview, is very important to adapting to the various circumstances, whether internal or external, that companies may face as they've moved into the public company space.
Great advice. Okay, well, we are nearing key takeaways and live Q&A, so drop those questions in the Q&A box if you've got them for our panelists. But one last question to this panel. So we've been talking about in our IPO bootcamp today, lots of things on what teams should do, what founders and executive teams should be thinking about and planning if listing is the option that they're looking at for their exit. So what in your expertise and experience, what should teams start doing now, even pre-IPO, to be successful as a public company? Shannon, I'll start with you.
I think it's all about the business, just taking it back to what I keep saying. And I think having quarterly earnings calls, with sometimes companies do it with a small investor group, but I think doing that to prepare, act as if you're a public company now and see what results you're getting. Because I mean, that also plays into the right time to go public. And I think, before you go public, you want to make sure that your business has a sustainable model that will be consistent for all of these quarterly evaluations that we put on you. So I think just making sure that you're able to close your books quickly and report earnings, and that you're able to guide. I think that's like a big part of it, is making sure that you're able to have good forecasts, because you're not required to give guidance, but almost everyone does. And if you give guidance and you can't meet your guidance, that is very bad. So making sure that you're able to figure out whether you're able to predict enough in your business to have that predictability to be a successful public company.
Okay, Prasad.
Yeah, I would try to highlight on the having the right strength in financial reporting systems and process, having the right systems in place and the cadence. Also, when you decide on the metrics, there's some metrics might be just an annual metric, because on a quarterly basis it might be a noise. So think about what you want to report on a quarterly basis and what would be an annual basis. So something, so that you're not distracted by the noise on the metrics on a quarterly basis, and you may not be able to hit it or guide the metric on a quarterly basis. So that's what I would say.
Great. Haley.
To tie those two together, I would say that having the founder, CEO, and board members that exist, if it's not a company that's public yet, really align around what is the corporate purpose and the vision for this company and its future. How is it that we foster operational excellence? How is it that we adopt a governance model that is one that can be adapted and molded to the company as it moves throughout its life cycle, whether it goes public, whether it stays private, or it does the bounce back and forth, which we're seeing companies do. But I think aligning on what the company is, and then how it's going to be run effectively to drive value for all of its stakeholders, depending on its status, is going to be important to maintaining that alignment, and then ensuring that everyone is committed to the purpose of driving that company's success. I think one risk that I've seen is whenever directors get added to a board right as the company's getting ready to go public, or in the near term thereafter, to where they come in to be a director. They don't come in because they are interested in the business. They're committed to its success. And then you end up with dysfunction, because you need those people at the top of the organization aligned. So it drives the organizational alignment and the external articulation of the company's value, which then can be adaptable to any number of circumstances, whether it's those that are being developed and planned internally, or in response to external factors that we can't always control.
Great advice all around. And we took a poll earlier of, are we 12 to 24 months out? Are we interested? Are we just here to learn more? Are we holding? And I think a decent amount of folks are in the pool of needing the advice that all three of you just gave. So thank you for that. If we were going to wrap up everything, all the advice that you said through this discussion into one key takeaway that you wouldn't want anybody in our audience to leave this conversation without knowing, what would it be, Shannon?
I think
Life
that
is a public company.
yeah, you probably heard throughout this presentation, there are a bunch of negatives, right? Who wants like to focus on short-termism, regulatory scrutiny, pouring time and resources into things that'll just hurt your bottom line doesn't always sound super attractive. But I think at the end of the day, hopefully, you'll all reach the point with your companies that the benefits outweigh the costs there. And they've been manageable, obviously, for many companies. I think in particular, the key benefits that I hear over and over again are just increased visibility for your brand and the ability to scale the business. Once you're a public company, just gives you, certain reputation, and it's just, you're able to kind of grow it at not a faster pace, but just grow at a bigger scale. And then we can't ignore liquidity for all, including all of your employees, the people that helped build the company along the way, and also key investors that might be pushing for it. So that's also not a bad thing. And hopefully if you're just up and to the right with your results over time, then everyone will be happy and sail off into the sunset.
Prasad?
Yeah, I would say having the right infrastructure to operate as a public company, having that infrastructure earlier on in the process, and when you're staying and on a private basis and doing a trial run, dry run, would be important to be successful as a public company.
Great advice. Kaylee, round us out.
I think public companies are such an integral part of the global economy. And so getting to be part of a company that's moving through that journey and into the, formative stages of being public, whether you're sitting there as the CEO or founder, someone that's recruited into the management team to help the company make that transition and move throughout its life cycle successfully, or whether you're a director coming in to do that, it is a very neat opportunity to get to propel the success of a business that's going to impact people around the world, as well as those that are directly touching your company through your investor base, your employees, and your customers. So I think that, despite the enormous amount of work that's required for public company directors and their executive teams, the impact is not only directly seen in the value that the company provides in its first few years as a public company, but I think has multiplying factors that can be seen over the long run, irrespective of a company's trajectory, whether they go from being a micro cap to a mega cap throughout their tenure, or they're companies that merge with others. There's all sorts of ways that companies really have impact. And I think that it's a very unique privilege to get to be a part of that process, irrespective of which seat you're sitting in, but supporting those companies that really are integral to helping US and global economies be successful and healthy.
Great key takeaways all around. Okay, well, for those of you in our audience, now we're taking live Q&A. Prasad, we have one with your name on it. So you've been talking about systems, and they have one question around systems. In a world where all financial ERP systems like SAP, Oracle, or others are cloud solutions that are flexible and scalable, do you think they are too early for a 100 million revenue company or even 50 million revenue company? I think they mean ARR.
Yeah. I think it depends on the company. I would say my example, what I gave was just one company who was seeing a hyper growth hyperscaler. And I would say, depending on the company, you'll need to do an assessment. Most of them are cloud solutions. And then most of them are also, I call it as an autonomous enterprise kind of a solutions, what they sell. In what I mean by autonomous enterprise is the end-to-end process is linked to where it's automated and there's little bit manual intervention. So I would think about what's the right system based on the system requirements of an individual company and in selecting the right vendor. That's what I would say.
Yeah, so it depends, but good to
Yeah.
know. I'll let whoever wants to take this one raise their hand, but we had a pre-submitted question here on what are some of the latest changes for public companies in 2025? And Shannon, that could be from a regulatory perspective.
Yeah.
Prasad, that could be from a finance perspective. Kaylee, from a governance perspective.
Probably from just all the macroeconomic factors that are happening right now, and policies of the new administration and all of that is really in looking at and helping public companies with their disclosures. Every couple of weeks it's like, hey, do we need a new risk factor about this or that? But you can add disclosure about hypotheticals, but really it's like, well, how is that new policy impacting your business specifically, or how do you think it will impact your business specifically? So it feels like there's more volatility in that regard than there has been in the past. And there are, some IPOs too that are kind of in the hopper that are sort of in wait and see mode as a result of that volatility. So I think that's different and notable this year.
I would say, I mean, from both a governance and a market perspective, it's been very interesting in the recent days to watch the number of companies that are backing off on guidance. And that's a decision being made by the CEO and the board as to what can we reliably tell our investors based on the macro factors that Shannon mentioned. I think from a demand on how I'm seeing that resonate in the work that directors are required to do, the demands on them for interim board meetings or calls, more calls for scenario planning, reassessing the company's financial health, access to capital, its liquidity, reassessing whether it's going to make what the board and CEO, even at January of this year, may have anticipated to be some significant investments throughout the course of this year. Boards are having to come back in and say, is that still prudent based on what's knowable? What's certain, what we can ensure will drive the growth and value that we see as being possible, but may be now hindered by broader conditions. And so I think that directors have gone from a place over the course of the past probably 15 to 20 years of going from, 200 hours per year would be normal for a public company director 2 decades ago. Now, I can't imagine, and especially with what I've seen in the first quarter of this year, directors saying 200 hours for a public company board is sufficient time between board meetings, interim calls, retreats, one-on-one conversations with the CEO or with one another to align on decisions that may be becoming before the board, and then educating themselves on what's happening so we come in with an informed view. That dynamic and the demand on directors is very tangible. And, I'm fortunately seeing that directors are stepping up to the circumstance and coming in with the diligence required. But I can't imagine what this is going to create in a more forward-looking circumstance with CEOs that lived through the pandemic and those challenging circumstances to now also having to endure very volatile macro conditions. Boards should be watching that closely and thinking about the importance of management succession planning too.
Prasad, anything to add on updates from 2025 for you?
Yeah, I don't think so. There's anything specific in 2025. So I have nothing much to add on that specifically.
Great. Well, we almost went a full boot camp without bringing in a question about AI, but there's one from the audience. So I don't know this answer, but are there any AI tools that you would recommend using to govern better as a public company? Are you seeing any tools that you personally are using that you enjoy? It's just a question that came in and I'm curious about.
Yeah, I can go first maybe. So I think there are multiple tools on AI from financial reporting process. There's some AI tool which reads on customer revenue contracts and summarizes the contracts on what are the key provisions and everything from an accounting analysis. So there are tools even in the close process. I would say, and day-to-day use of AI tools is like on a co-pilot and other stuff, which is also helpful. So I think you should think about more AI tools in a broad manner and more like what I highlight as an autonomous enterprise mode, like what you could get as minimum manual intervention as possible. and that will be a complete system a process redesign. So
I think that AI has obviously the great ability to help with operational efficiency in whatever organization you're working on or in, and I hear boards talking about that quite a lot. I think that our clients are using AI perhaps more than we are at this stage, but within our firm, we're also piloted some tools and are looking at ways to make things more efficient. For me personally, I would love to see side-by-side comparisons of SEC disclosures with AI being able to point out differences. I know there are some tools out there that can do that, but it's also sensitive because we have a lot of client information, obviously, at a law firm, and so we have to be sort of careful about using AI on publicly available information versus client information. So there's a lot of thinking that I think law firms and other companies are doing on this front. So no perfect answer quite yet, but I think everyone's trying to find the right balance here.
Of course.
Yeah. I would say from a personal perspective, I personally just enjoy playing with all of the AI tools, whether it's Microsoft Copilot or any of the other apps that are there, so I can really get an understanding of how they work, and then also look at it from a data accuracy perspective. Google has, if you search now, it puts its AI results up at the top, and there are times where I'm like, that's not a fact, and I click their link and it's going to some not verifiable source. And so I think it's important to, for people who are engaged and intellectually curious to understand what tools exist and how to use them. But Shannon's point around, in particular for directors who may be looking to AI tools to ensure that they are vetting use of any with their inside counsel and outside counsel, so they're not putting sensitive information and in particular non-public information into a tool that may not keep that as secure as it needs to. And then, importantly, looking to see what are the opportunities that can be availed of that, because I think that there's a lot of excitement and sentiment analysis, and even within NASDAQ's NASDAQ Board Vantage, our board portal solution, we've actually just released a whole new suite of AI solutions that we're building within the portal itself. So directors, corporate secretaries, and executives have access to AI in that secure environment where the company information is being maintained appropriately, but directors can find efficiency in the way that they're reviewing materials and correlating data points in different parts of the board book, or the corporate secretary and CEO are creating AI automated board meeting minutes, which can be such a laborious process. So, there's a lot of opportunities, but I would say being careful about the use case and protecting sensitive information would always be my starting point, and then building on the curiosity and the excitement of how it can help propel a company and a board forward.
Great. See, you did all have great responses to that. I wasn't sure. But yes, I totally understand the internal tools. The information needs to be protected. There's a question here that I want to remove the past month and a half of market from. How do we prepare for potential challenges or volatility in our stock performance during our initial weeks?
In the initial weeks.
Yeah, like so.
I don't think you
last
can.
month, last month didn't occur. Last month didn't occur.
Oh,
How can we
I don't
prepare for
I don't think you
volatility?
can. I don't think you can.
Yeah.
I don't think you can. I don't know. I mean, at that point in time, like, you went out with the information that you went out with, right? And the market is kind of digesting and receiving it, and absent releasing new information at that time, I mean, it kind of just is what it is. So I don't know. I would just encourage you to brace yourself and go along for the ride. Make sure that the IPO is being priced the right way, probably is like the only factor that you could control. Because if you're worried about stock going down, you can price lower and then it won't go down as much, or vice versa, right? Like, stock is going way up, try to get a higher price. I mean, that's the tool that you can, but I don't know that you can really control, especially in those first couple of weeks, anything.
Great. Moving on. There's another question here. This is on the employee front of things, so feel free to jump in. For whoever likes it or can answer it, what changes should we anticipate in our company culture and operations post-IPO?
So I think Shannon hit on this earlier today. You know, there's going to be a difference in the amount of information, and it may have even been discussed in one of the earlier panels, the amount of information that can be discussed internally as a public company than what was probably shared more broadly as a private company. And, you know, I think that there's a very important roadmap that needs to be laid in terms of education for employees for new requirements that they may have in place. Things as simple as expense controls and reporting. You know, in a private company, there may not have been such specified standards for reporting your expenses and how they should be reported and with what detail of information that employees just may not be used to. So getting on that roadmap of educating employees across various levels and with policies specific to their responsibilities are important. And I think also having a good communications team that helps employees understand what information they should be sharing with outside parties, that, you know, as a private company, you may get to say, hey, we're, you know, partner, spouse, friend, we're really working on this exciting project. As a public company, they may not get the luxury of talking about things that are in development for the company that aren't already public. So having processes on education and policy and then protocols, if employees are going to be speaking on behalf of the company outside of those in the C-suite, doing the work there so you don't get into a place where somebody makes an inadvertent misstep because they're excited about the company's next journey and next phase, but they just didn't understand the greater context in which they sit.
Anything to add there, Shannon, Prasad?
Yeah, just, I mean, regulation FD is what governs here, and you can't make selective disclosures to people that could be trading on information. I mean, but there's no rule that says companies cannot share information with their employees all the time. I mean, so that's not against the law, but it's just trying to create that culture of compliance and put your employees in the best spot. It's a little paternalistic to say we're going to purposely withhold information from you because we're worried that you're going to go out and trade on it, but that's a real thing, and that happens a lot. You know, people just didn't realize, oh, we were in a blackout window and you sold some shares, and so it just, that kind of thing happens. And just, yeah, educating. I think insider trading policy is another one that's sort of a big one. In that regard, like there are things that companies might want to prohibit. Like, for example, we get lots of questions about employees that are trying to do hedging style transactions with their company stock. And again, that's not necessarily an insider trading problem. It's just a more of an optics problem, and companies don't really.
For our closing, but what a great way to end this IPO Bootcamp. Kaylee, Prasad, Shannon, hopefully will be joining us in a moment, but thanks for joining us today to share your real advice and some of your best practices and tools with our audience today.
Thank you.
Thank you, Prasad. And hopefully Shannon's computer didn't explode, but we're thanking her from afar. And also for everyone on the call, thank you all for joining us. We hope this was insightful and helpful. Your feedback is valued. So if you're interested in meeting with our partners and giving us some feedback on this bootcamp, please take a moment to complete the survey in the chat box. But on behalf of everyone on our team and our panelists today, thank you for joining us, and we look forward to welcoming you all back online soon. Thanks again, everyone.
Thank you.